commentary on chapter 18 runs, "The thing that hath been, it is that which shall be. And that which is done is that which shall be done. And there is no new thing under the sun. Is there anything whereof it may be said, See, this is new? It hath been already of old time, which was before us." Ecclesiastes 9:10. Let's update Graham's classic write-up of 8 pairs of companies. Using the same compare and contrast technique that he pioneered in his lectures at Columbia Business School and the New York Institute of Finance. Bear in mind that these summaries describe these stocks only at the time specified. The cheap stocks may later become overpriced. The expensive stocks may turn cheap. At some point in its life, almost every stock is a bargain. At another time, it will be expensive. Although there are good and bad companies, there is no such thing as a good stock. There are only good stock prices, which come and go. Pair 1. Cisco and Cisco on March 27, 2000's Cisco Systems, Inc. became the world's most valuable corporation as its stock hit $548 billion in total value. Cisco, which makes equipment that directs data over the internet, first sold its shares to the public only 10 years earlier. Had you bought Cisco's stock in the initial offering and kept it, you would have earned a gain resembling a typographical error made by a madman. 13697%, or a 217% average annual return. Over its previous 4 fiscal quarters, Cisco had generated $14.9 billion in revenues and $2.5 billion in earnings. The stock was trading at 219 times Cisco's net income, one of the highest price-earnings ratios ever recorded to a large company. Then there was Cisco Corp., which supplies food to institutional kitchens and had been publicly traded for 30 years. Over its last 4 quarters, Cisco served up $17.7 billion in revenues, almost 20% more than Cisco, but only $457 million in net income. With a market value of $11.7 billion, Cisco shares traded at 26 times earnings, well below the market's average PE ratio of 31%. A word association game with a typical investor might have gone like this. Q, what are the first things that pop into your head when I say Cisco Systems? A, the internet, the industry of the future, great stock, hot stock. Can I please buy some before it goes up even more? Q, and what about Cisco Corp? A, delivery trucks, succotash, sloppy joes, shepherd's pie, school lunches, hospital food. No thanks, I'm not hungry anymore. It's well established that people often assign a mental value to stocks based largely on the emotional imagery that companies evoke. But the intelligent investor always digs deeper. Here's what a skeptical look at Cisco and Cisco's financial statements would have turned up. Much of Cisco's growth in revenues and earnings came from acquisitions. Since September alone, Cisco had ponied up to $20 billion to buy 11 other firms. How could so many companies be mashed together so quickly? Also, tax breaks on stock options exercised by Cisco's executives and employees amounted to the equivalent of roughly 1/3 of the company's total earnings over the previous 6 months. And Cisco had gained $5.8 billion selling investments, then bought $6 billion more. Was it an internet company or a mutual fund? What if those investments stopped going up? Cisco had also acquired several companies over the same period, but paid only about $130 million. Stock options for Cisco's insiders total only 1.5% of shares outstanding versus 6.9% at Cisco. If insiders cashed their options, Cisco's earnings per share would be diluted much less than Cisco's. And Cisco had raised its quarterly dividend from 9 cents a share to 10. Cisco paid no dividend. Finally, as Wharton finance professor Jeremy Siegel pointed out, no company as big as Cisco had ever been able to grow fast enough to justify a price-earnings ratio above 60%, let alone a PE ratio over 200.3%. Once a company becomes a giant, its growth must slow down, or it will end up eating the entire world. The great American satirist Ambrose Bierce coined the word incompossible to describe 2 things that are conceivable separately but cannot exist together. A company can be a giant, or it can deserve a giant PE ratio, but both together are incompossible. The wheels soon came off the Cisco juggernaut. First, in 2001, came a $1.2 billion charge to restructure some of those acquisitions. Over the next 2 years, $1.3 billion in losses on those investments leaked out. From 2000s through 2002, Cisco's stock lost 3/4 of its value. Cisco, meanwhile, kept dishing out profits, and the stock gained 56% over the same period. See figure 18-1. Pair 2, Yahoo and Yum. On November 30th, 1999, Yahoo Inc. stock closed at $212.75, up 79.6% since the year began. By December 7th, the stock was at $348, a 63.6% gain in 5 trading days. Yahoo kept whooping along through year-end, closing at $432.687 on December 31st. In a single month, the stock had more than doubled, gaining roughly $58 billion, to reach a total market value of $114 billion. In the previous 4 quarters, Yahoo had racked up $433 million in revenues and $34.9 million in net income. So Yahoo stock was now priced at 263 times revenues and 3,264 times earnings. Remember that a PE ratio much above 25 made Graham grimace. 5. Why was Yahoo screaming upward? After the market closed on November 30th, Standard & Poor's announced that it would add Yahoo to its S&P 500 index as of December 7. That would make Yahoo a compulsory holding for index funds and other big investors, saying that sudden rise in demand was sure to drive the stock even higher, at least temporarily. With some 90% of Yahoo stock locked up in the hands of employees, venture capital firms, and other restricted hold, just a fraction of its shares could trade. So thousands of people bought the stock only because they knew other people would have to buy it and price was no object. Meanwhile, Yum went begging, a former division of PepsiCo that runs thousands of Kentucky Fried Chicken, Pizza Hut, and Taco Bell. Eateries Yum had produced $8 billion in revenues over the previous 4 quarters, on which it earned $633 million, making it more than 17 times Yahoo's size. Yet Yum's stock market value at year-end 1999 was only $5.9 billion, or 1/19 of Yahoo's capitalization. At that price, Yum stock was selling at just over 9 times its earnings and only 73% of its revenues. As Graham liked to say, in the short run the market is a voting machine, but in the long run it is a weighing machine. Yahoo won the short-term popularity contest. But in the end, it's earnings that matter, and Yahoo barely had any. Once the market stopped voting and started weighing, the scales tipped toward Yum. Its stock rose 25.4% from 2000 through 2002, while Yahoo's lost 92.4% cumulatively. Defalia ZW, $1,010, other 200, Mark, Show, Rep, Net. Design's internet exchanges for corporate purchasing departments showed assets of just $385 million and reported a net loss of $63 million on only $34 million in total revenues. The stock of this minuscule company had risen nearly 900% since its IPO, hitting a total market capitalization of $15 billion. Was it overpriced? Yes, we have a big market cap, Commerce One's chief executive Mark Hoffman shrugged in an interview. But we have a big market to play in. We're seeing incredible demand. Analysts expect us to make $140 million, lion in revenue this year. And in the past, we have exceeded expectations. 2 things jump out from Hoffman's answer. Since Commerce One was already losing $2 on every dollar in sales, if it quadrupled its revenues, as analysts expect, wouldn't it lose money even more massively? How could Commerce One have exceeded expectations in the past? What past? Asked whether his company would ever turn a profit, Hoffman was ready. There is no question we can turn this into a profitable business. We plan on becoming profitable in the 4th quarter of 2001, a year analysts see us making over $250 million in revenues. There come those analysts again. I like Commerce One at these levels because it's growing faster than Ariba, a close competitor, whose stock was also trading at around 400 times revenues, said Jeanette Singh, an analyst at the Wasserstein Perella Investment Bank. If these growth rates continue, Commerce One will be trading at 60 to 70 times sales in 2001. In other words, I can name a stock that's more overpriced than Commerce One, so Commerce One is cheap. At the other extreme was Capital One Financial Corp., an issuer of MasterCard and Visa credit cards. From July 1999 to May 2000s, its stock lost 21.5%. Yet Capital One had $12 billion in total assets and earned $363 million in 1999, up 32% from the year before. With a market value of about $7.3 billion, the stock sold at 20 times Capital One's net earnings. All might not be well at Capital One. The company had barely raised its reserves for loans that might go bad. Even though, PA on, default rates tend to jump in a recession, but its stock price reflected at least some risk of potential trouble. What happened next? In 2001, Commerce One generated $409 million in revenues. Unfortunately, it ran a net loss of $2.6 billion or $10.30 of red ink per share on those revenues. Capital One, on the other hand, earned nearly $2 billion in net income in 2000s through 2002. Its stock lost 38% in those 3 years, no worse than the stock market as a whole. Commerce One, however, lost 99.7% of its value. 3 instead of listening to Hoffman and his lapdog analysts. Traders should have heeded the honest warning in Commerce One's annual report for 1999. We have never been profitable. We expect to incur net losses for the foreseeable future, and we may never be profitable. Pair 4, Palm and 3Com. On March 2nd, 2000s, the data networking company 3Com Corp. sold 5% of its Palm Inc. subsidiary to the public. The remaining 95% of Palm's stock would be spun off to 3Com shareholders in the next few months. For each share of 3Com they held, investors would receive 1.525 shares of Palm. So there were two ways you could get 100 shares of Palm: by trying to elbow your way into the IPO or by buying 66 shares of 3% Com and waiting until the parent company distributed the rest of the Palm stock. Getting 1.5 shares of Palm for each 3Com share, you'd end up with 100 shares of the new company, and you'd still have 66 shares of 3% Com. But who wanted to wait a few months? While 3Com was struggling against giant rivals like Cisco, Palm was a leader in the hot space of handheld digital organizers. So Palm stock shot up from its offering price of $38 to close at $95.06, a 150% first-day return. That valued Palm at more than 1,350 times its earnings over the previous 12 months. That same day, 3Com's share price dropped from $104.13 to $81.81. Where should 3Com have closed that day given the price of Palm? The arithmetic is easy. Each 3Com share was entitled to receive 1.525 shares of Palm. Each share of Palm closed at $95.06, 1.525x. $95.06, $144.97 trillion. That's what each 3Com share was worth based on its stake in Palm alone. Thus, at $81.81, traders were saying that all of 3Com's other businesses combined were worth a negative $63.16 per share, or a total of minus $22 billion. Rarely in history has any stock been priced more stupidly, but there was a catch. Just as 3% Com wasn't really worth minus the end of 2002, both stocks were hurting in the high-tech recession. $22 billion, Palm wasn't really worth over 350 times earnings. But it was Palm's shareholders who really got smacked because they abandoned all common sense when they bought in the first place. Pay 5 rands, CMGI, and CGI. The year 2000 started off with a bang for CMGI Inc. as the stock hit $163.22 on January 3, a gain of 126% over its price just 1 year before. The company, an internet incubator, financed and acquired startup firms in a variety of online businesses, among them such early stars as theglobe.com and Lycos. In fiscal year 1998, as its stock rose from 98 cents to $8.52, CMGI spent $53.8 million acquiring whole or partial stakes in internet companies. In fiscal year 1999, as its stock shot from $8.52 to $46.09, CMGI shelled out $104.7 million. And in the last 5 months of 1999, as its shares zoomed up to $138.44, CMGI spent $4.1 billion on acquisitions. Virtually all the money was CMGI's own privately minted currency, its common stock now valued at a total of more than $40 billion. It was a kind of magical money merry-go-round. The higher CMGI's own stock went, the more it could afford to buy. The more CMGI could afford to buy, the higher its stock went. First, stocks would go up on the rumor that CMGI might buy them. Then, once CMGI acquired them, its own stock would go up because it owned them. No one cared that CMGI had lost $127 million on its operations in the latest fiscal year, down in Webster, Massachusetts, less than 70 miles southwest of CMGI's headquarters in Andover sits the main office of Commerce Group, Inc. CGI was everything CMGI was not. Offering automobile insurance mainly to drivers in Massachusetts, it was a cold stock in an old industry. Its shares lost 23% in 1999, although its net income at $89 million ended up falling only 7% below 1,998 feet's level. CGI even paid a dividend of more than 4%, CMGI paid none, with a total MAR. Cap value of $870 million, CGI stock was trading at less than 10 times what the company would earn for 1999. And then, quite suddenly, everything went into reverse. CMGI's magical money merry-go-round screeched to a halt. It's .com. Stock stopped rising in price. Then went straight down, no longer able to sell them for profit. CMGI had to take their loss in value as a hit to its earnings. The company lost $1.40 billion in 2000's $5.5 billion in 2001, and nearly $500 million more. In 2002, its stock went from $163.22 at the beginning of 2000s to 98 cents by year-end 2002, a loss of 99.4%. Boring old CGI, however, kept cranking out steady. Earnings and its stock rose 8.5% in 2000s, 43.6. In 2001, and 2.7%. In 2002, a 60% cumulative gain. Pasix Rands, Ball and Stryker by Nirlasol, Wingpu. Jones Plunge, Anfoth, SRSTA Kenk, prices, Asha 04. Sale. Between July 9th and July 23, 2002, Ball Corp stock dropped from $43.69 to $33.48, a loss of 24% that left the company with a stock market value of $1.9 billion. Over the same 2 weeks, Stryker Corp. shares fell from $49.55 to $45.60. An 8% drop that left Stryker valued at a total of $9 billion. What had made these two companies worth so much less in so short a time? Stryker, which manufactures orthopedic implants and surgical equipment, issued only one press release during those 2 weeks. On July 16, Stryker announced that its sales grew 15% to $734 million in the second quarter, while earnings jumped 31% to $86 million. The stock rose 7% the next day, then rolled right back, downhill. B. Pennsylvania, the Corm Ball, the original maker of the famous ball jars used for canning fruits and vegetables, now makes metal and plastic packaging for industrial customers. Ball issued no press releases at all during those 2 weeks. On July 25, however, Ball reported that it had earned $50 million on sales of $1 billion in the second quarter, a 61% rise in net income over the same period 1 year earlier. That brought its earnings over the trailing 4 quarters to $152 million, so the stock was trading at just 12.5 times Ball's earnings. And with a book value of $1.1 billion, you could buy the stock for 1.7 times what the company's tangible assets were worth. Ball did, however, have just over $900 million in debt. Stryker was in a different league. Over the last 4 quarters, the company had generated $301 million in net income. Stryker's book value was $570 million, so the company was trading at fat multiples of 30 times its earnings over the past 12 months and nearly 16 times its book value. On the other hand, from 1992 through the end of 2001, Stryker's earnings had risen 18.6% annually. Its dividend had grown by nearly 21% per year. And in 2001, Stryker spent $142 million on research and development to lay the groundwork for future growth. What then had pounded these two stocks down? Between July 9 and July 23, 2002, as WorldCom keeled over into bankruptcy, the Dow Jones Industrial Average fell from 9,096.09 to 7,702.34, a 15.3% plunge. The good news that Ball and Stryker got lost in the bad headlines and falling markets, which took these two stocks down with them. Although Ball ended up priced far more cheaply than Stryker, the lesson here is not that Ball was a steal and Stryker was a wild pitch. Instead, the intelligent investor should recognize that market panics can create great prices for good companies, like Ball, and good prices for great companies, like Stryker. Ball finished 2002 at $51.19 a share, up 53% from its July low. Stryker ended the year at $67.12, up 47%. Every once in a while, value and growth stocks alike go on sale. Which choice you prefer depends largely on your own personality, but bargains can be had on either side of the plate. Pays Evan Rands, Nortel and Nortec. The 1999 annual report for Nortel Networks, the fiber optic equipment company, boasted that it was a golden year financially. As of February 2000s, at a market value of more than $150 billion, Nortel's stock traded at 87 times the earnings that Wall Street's analysts estimated the company would produce in 2000s. How credible was that estimate? Nortel's accounts receivable sales to customers that had not yet paid the bill had shot up by $1 billion in a year. The company said the rise was driven by increased sales in the fourth quarter of 1999, however. Inventories had also ballooned by $1.2 billion, meaning that Nortel was producing equipment even faster than those increased sales could unload at Tel was. Meanwhile, Nortel's long-term receivables bills not yet paid for multi-year contracts jumped from $519 million to $1.4 billion. And Nor, having a hard time controlling costs. Its selling, general, and administrative expense, or overhead, had risen from 17.6% of revenues in 1997 to 18.7% in 1999. All told, Nortel had lost $351 million in 1999. Then there was Nortec Inc., which produces stuff at the dim end of the glamour spectrum. Vinyl siding, door chimes, exhaust fans, range hoods, trash compactors. In 1999, Nortec earned $49 million on $2 billion in net sales, up from $21 million in net income on $1.1 billion in sales in 1997. Nortec's profit margin net earnings as a percentage of net sales had risen by almost a third from 1.9 to 2.5%, and Nortec had cut overhead from 19.3% of revenues to 18.1%. To be fair, much of Nortec's expansion came from buying other companies, not from internal growth. What's more, Nortec had $1 bill. Line in debt, a big load for a small firm. But in February 2000s, Nortec's stock price roughly 5 times its earnings in 1999 included a healthy dose of pessimism. On the other hand, Nortel's price eminence 87 times the guesstimate of what it might earn in the year to come was a massive overdose of optimism. When all was said and done, instead of earning the $1.30 per share that analysts had predicted, Nortel lost $1.17 per share in 2000s. By the end of 2002, Nortel had bled more than $36 billion in red ink. Nortec, on the other hand, earned $41.6 million in 2000s, $8 million in 2001, and $55 million in the first 9 months of 2002. Its stock went from $28 a share to $45.75 by year-end 2002, a 63% gain. In January 2003, Nortec's managers took the company private, buying all the stock from public investors at $46 per share. Nortel's stock, meanwhile, sank from $56.81 in February 2000s to $1.61 at year-end 2002, a 97% loss. Pair 8, Red Hat and Brown Shoe. On August 11, 1999, Red Hat Inc., a developer of Linux software, sold stock to the public for the first time. Red Hat was red hot initially. Offered at $7, the shares opened for trading at $23 and closed at $26.03, $1, a 272% gain. In a single day, Red Hat stock had gone up more than Brown Shoes had in the previous 18 years. By December 9th, Red Hat's shares hit $143.13, up 1,944% in 4 months. Brown Shoe, meanwhile, had its laces tied together. Founded in 1878, the company wholesales Buster Brown shoes and runs nearly 300 footwear stores in the United States and Canada. Brown Shoes. Stock at 17 defty cents a share on August 11th. Stumbled down to $14.31 by December 9th. For all of 1999, Brown Shoe shares lost 17.6%, 12. Besides a cool name and a hot stock, what did Red Hat's investors get? Over the 9 months ending November 30, the company produced $13 million in revenues, on which it ran a net loss of $9 million. Lion 13, Red Hat's business, was barely bigger than a street corner delicatessen and a lot less lucrative. But traders, inflamed by the words, software, and internet, drove the total value of Red Hat's shares to $21.3 billion by December 9th. And Brown Shoe? Over the previous 3 quarters, the company had produced $1.2 billion in net sales and $32 million in earnings. Brown Shoe had nearly $5 a share in cash and real estate. Kids were still buying Buster Brown shoes. Yet that December 9th, Brown Shoe stock had a total value of $261 million, barely 1/80th the size of Red Hat, even though Brown Shoe had 100 times Red Hat's revenues. At that price, Brown Shoe was valued at 7.6 times its annual earnings and less than 1/4 of its annual sales. Red Hat, on the other hand, had no profits at all, while its stock was selling at more than 1,000 times its annual sales. Red Hat, the company, kept right on gushing red ink. Soon enough, the stock did too. Brown Shoe, however, trudged out more profits, and so did its shareholders. What have we learned? The market scoffs at Graham's principles in the short run, but they are always revalidated in the end. If you buy a stock purely because its price has been going up, instead of asking whether the underlying company's value is increasing, then sooner or later you will be extremely sorry. That's not a likelihood. It is a certainty. P. Chapter 19, RANDs, Shareholders and Managements, Dividend Policy. Ever since 1934, we have argued in our writings for a more intelligent and energetic attitude by shareholders toward their managements. We have asked them to take a generous attitude toward those who are demonstrably doing a good job. We have asked them also to demand clear and satisfying explanations when the results appear to be worse than they should be, and to support movements to improve or remove clearly unproductive managements. Shareholders are justified in raising questions as to the competence of the management when the results, one, are unsatisfactory, Nes that appear similarly situated. And 3 have resulted in N. In themselves, 2 are poorer than those obtained by other compa. In the last 36 years, practically nothing has actually been accomplished through intelligent action by the great body of shareholders. A sensible crusader, if there are any such, would take this as a sign that he has been wasting his time and that he had better. Oath of fight. As it happens, our cause has not been lost. It has been rescued by an extraneous development known as takeovers or takeover bids. We said in chapter that poor manage. Unsatisfactory market price of long duration. Give up. Ments produce poor market prices. The low market prices, in turn, attract the attention of companies interested in diversifying their operations, and these are now legion. Innumerable such acquisitions have been accomplished by agreement with the existing managements, or else by accumulation of shares in the market and by offers made over the head of those in control. The price bid has usually been within the range of the value of the enterprise under reasonably competent management. Hence, in many cases, the inert public shareholder has been bailed out by the actions of outsiders who at times may be enterprising individuals or groups acting on their own. It can be stated as a rule, with very few exceptions, that poor managements are not changed by action of the public stockholders, but only by the assertion of control by an individual or compact group. This is happening often enough these days to put the management, including the board of directors, of a typical publicly controlled company on notice that if its operating results and the resulting market price are highly unsatisfactory, it may become the target of a successful takeover move. As a consequence, boards of directors have probably become more alive than previously to their fundamental duty to see that their company has a satisfactory top management. Many more changes of presidents have been seen in recent years than formerly. Not all companies in the unsatisfactory class have benefited from such developments. Also, the change has often occurred after a long period of bad results without remedial action, and is dependent on enough disappointed shareholders selling out at low prices to permit the energetic outsiders to acquire a controlling position in the shares. But the idea that public shareholders could really help themselves by supporting moves for improving agent and management policies has proved too quixotic. Man, rant further space in this book. Those individual shareholders who have enough gumption to make their presence felt at annual meetings, generally a completely futile performance, will not need our counsel on what points to raise with the managements. For others, the advice would probably be wasted. Nevertheless, let us close this section with the plea that shareholders consider with an open mind and with careful attention any proxy material sent them by fellow shareholders who want to remedy an obviously unsatisfactory management situation in the company. Shareholders and dividend policy. In the past, the dividend policy was a fairly frequent subject of argument between public or minority shareholders and managements. In general, these shareholders wanted more liberal dividends, while the managements preferred to keep the earnings in the business to strengthen the company. They asked the shareholders to sacrifice their present interests for the good of the enterprise and for their own future long-term benefit. But in recent years, the attitude of investors toward dividends has been undergoing a gradual but significant change. The basic argument now for paying small rather than liberal dividends is not that the company needs the money, but rather that it can use it to the shareholders. Direct and immediate advantage by retaining the funds for profitable expansion. Years ago, it was typically the weak company that was more or less forced to hold on to its profits instead of paying out the usual 60% to 75% of them in dividends. The effect was almost always adverse to the market price of the shares. Nowadays, it is quite likely to be a strong and growing enterprise that deliberately keeps down its dividend payments with the approval of investors and speculators alike. There was always a strong theoretical case for reinvesting prof. It's in the business where such retention could be counted on to produce a goodly increase in earnings. But there were several strong counter-arguments, such as the profits belong to the shareholders and they're entitled to have them paid out within the limits of prudent management. Many of the shareholders need their dividend income to live on. The earnings they receive in dividends are real money, while those retained in the company may or may not show up later as tangible values for the shareholders. These counter-arguments were so compelling, in fact, that the stock market showed a persistent bias in favor of the liberal dividend payers, as against the companies that paid no dividends or relatively small ones won. In the last 20 years, the profitable reinvestment theory has been gaining ground. The better the past record of growth, the readier investors and speculators have become to accept a low payout policy. So much is this true that in many cases of growth, favorites the dividend rate or even the absence of any dividends seem to have virtually no effect on the market price. A striking example of this development is found in the history of Texas Instruments, Incorporated. The price of its common stock rose from 5 cents in 1953 to 256 in 1960, while earnings were advancing from 43 cents to $3.91 per share, and while no dividend of kind was paid. In 1962, cash dividends were initiated, but by that year, the earnings had fallen to $2.14, and the price had shown a spectacular drop to a low of any. Another extreme illustration is provided by Superior Oil. In 1948, the company reported earnings of $35.26 per share, paid $3 in dividends, and sold as high as $235. In 1953, the dividend was reduced to $1, but the high price was $660. In 1957, it paid no dividend at all and sold at $2,000. This unusual issue later declined to $795 in 1962 when it earned $49.50 and paid $750. The investment sentiment is far from crystallized in this matter of dividend policy of growth companies. The conflicting views are well illustrated by the cases of two of our very largest corpora, Schun's American Telephone and Telegraph and International Business Machines. American Intel, came to be regarded as an issue with good growth possibilities, as shown by the fact that in 1961 it sold at 25 times that year's earnings. Nevertheless, the company's cash dividend policy has remained an investment and speculative consideration of first importance, its quotation making an active response to even rumors of an impending increase in the dividend rate. On the other hand, comparatively little attention appears to have been paid to the cash dividend on IBM, which in 1960 yielded only 0.5% the high price of the year and 1.5% at the close of 1970. But in both cases, stock splits have operated as a potent stock market influence. The market's appraisal of cash dividend policy appears to be developing in the following direction. Where prime emphasis is not placed on growth, the stock is rated as an income issue, and the dividend rate retains its long-held importance as the prime determinant of market price. At the other extreme, stocks clearly recognized to be in the rapid growth category are valued primarily in terms of the expected growth rate over, say, the next decade, and the cash dividend rate is more or less left out of the reckoning. While the above statement may properly describe present tendencies, it is by no means a clear-cut guide to the situation in all common stocks, and perhaps not in the majority of them. For one thing, many companies occupy an intermediate position between growth and non-growth enterprises. It is hard to say how much importance should be ascribed to the growth factor in such cases, and the market's view thereof may change radically from year to year. Secondly, there seems to be something paradoxical about requiring the companies showing slower growth to be more liberal with their cash dividends, for these are generally the less prosper the company the us concerns, and in the past, the more prosperous greater was the expectation of both liberal and increasing payments. It is our belief that shareholders should demand of their managements either a normal payout of earnings on the order, say, of 2/3, or else a clear-cut demonstration that the reinvested profits have produced a satisfactory increase in per-share earnings. Such a demonstration could ordinarily be made in the case of a recognized growth company, but in many other cases, a low payout is clearly the cause of an average market price that is below fair value, and here the shareholders have every right to inquire and, probably to complain. A niggardly policy has often been imposed on a company because its financial position is relatively weak and has needed all or most of its earnings plus depreciation charges to pay debts and bolster its working capital position. When this is so, there is not much the shareholders can say about it except perhaps to criticize the management for permitting the company to fall into such an unsatisfactory financial position. However, dividends are sometimes held down by relatively unprosperous companies for the declared purpose of expanding the business. We feel that such a policy is illogical on its face and should require both a complete explanation and a convincing defense before the shareholders should accept it. In terms of the past record, there is no reason a priori to believe that the owners will benefit from expansion moves undertaken with their money by a business showing mediocre results and continuing its old management. Stock dividends and stock splits, it is important that investors understand the essential difference between a stock dividend, properly so called, and a stock split. The latter represents a restatement of the common stock structure, in a typical case by issuing 2 or 3 shares for 1. The new shares are not related to specific earnings reinvested in its PE, specific past period. Its purpose is to establish a lower market price for the single shares, presumably because such lower price range, too, would be more acceptable to old and new shareholders. A stock split may be carried out by what technically may be called a stock dividend, which involves a transfer of sums from earned surplus to capital account, or else by a change in par value, which does not affect the surplus account. What we should call a proper stock dividend is one that is paid to shareholders to give them a tangible evidence or representation of specific earnings which have been reinvested in the business for their account over some relatively short period in the recent past, say, not more than the 2 preceding years. It is now approved practice to value such a stock dividend at the approximate value at the time of declaration and to transfer an amount equal to such value from earned surplus to capital accounts, thus the amount of. A typical stock dividend is relatively small, in most cases not more than 5%. In essence, a stock dividend of this sort has the same overall effect as the payment of an equivalent amount of cash out of earnings when accompanied by the sale of additional shares of like total value to the shareholders. However, a straight stock dividend has an important tax advantage over the otherwise equivalent combination of cash dividends with stock subscription rights, which is the almost standard practice for public utility companies. The New York Stock Exchange has set the figure of 25% as a practical dividing line between stock splits and stock dividends. Those of 25% or more need not be accompanied by the transfer of their market value from earned surplus to capital and so forth. Some companies, especially banks, still follow the old practice of declaring any kind of stock dividend they please, e.g. one of, not related to recent earnings, and these instances maintain an undesirable confusion in the financial world. We have long been a strong advocate of a systematic and clearly enunciated policy with respect to the payment of cash and stock dividends. Under such a policy, stock dividends are paid periodically to capitalize all or a stated portion of the earnings reinvested in the business. Such a policy covering 100% of the reinvested earnings has been followed by Purex, government employees insurance, and perhaps a few others. Stock dividends of all types seem to be disapproved of by most academic writers on the subject. They insist that they are nothing but pieces of paper, that they give the shareholders nothing they did not have before, and that they entail needless expense and inconvenience. On our side, we consider this a completely doctrinaire view, which fails to take into account the practical and psychological realities of investment. True, A periodic stock dividend, say, of 5% changes only the form of the owner's investment. He has 105 shares in place of 100, but without the stock dividend, the original 100 shares would have represented the same. Ownership interest now embodied in his 105 shares. Nonetheless, the change of form is actually one of real importance and value to him. If he wishes to cash in his share of the reinvested profits, he can do so by selling the new certificate sent him instead of having to break up his original certificate. He can count on receiving the same cash dividend rate on 105 shares as formerly on his 100 shares. A 5% rise in the cash dividend rate without the stock dividend would not be nearly as probable. The advantages of a periodic stock dividend policy are most evident when it is compared with the usual practice of the public utility companies of paying liberal cash dividends and then taking back a good part of this money from the shareholders by selling them additional stock through subscription rights. As we mentioned above, the shareholders would find themselves in exactly the same position if they received stock dividends in lieu of the popular combination of cash dividends followed by stock subscriptions, except that they would save the income tax otherwise paid on the cash dividends. Those who need or wish the maximum annual cash income with no additional stock can get this result by selling their stock dividends in the same way as they sell their subscription rights under present practice. The aggregate amount of income tax that could be saved by substituting stock dividends for the present stock dividends plus subscription rights combination is enormous. We urge that this change be made by the public utilities despite its adverse effect on the U.S. Treasury, because we are convinced that it is completely inequitable to impose a second personal income tax on earnings which are not really received by the shareholders, since the companies take the same money back through sales of stock. Efficient corporations continuously modernize their facilities, their products, their bookkeeping, their management training programs, their employee relations. It is high time they thought about modernizing their major financial practices, not the least important of which is their dividend policy. Commentary on Chapter 19. The most dangerous untruths are truths slightly distorted. G.C. Lichtenberg. Why did Graham throw in the towel? Perhaps no other part of The Intelligent Investor was more drastically changed by Graham than this. In the first edition, this chapter was one of a pair that together ran nearly 34 pages. That original section, the investor as business owner, dealt with shareholders' voting rights, ways of judging the quality of corporate management, and techniques for detecting conflicts of interest between insiders and outside investors. By his last revised edition, however, Graham had pared the whole discussion back to less than 8 terse pages about dividends. Why did Graham cut away more than 3/4 of his original argument? After decades of exhortation, he evidently had given up hope that investors would ever take any interest in monitoring the behavior of corporate managers. But the latest epidemic of scandal allegations of managerial misbehavior, shady accounting, or tax maneuvers at major firms like AOL, Enron, Global Crossing, Sprint, Tyco, and WorldCom is a stark reminder that Graham's earlier warnings about the need for eternal vigilance are more vital than ever. Let's bring him back and discuss them in light of today's events. Theory versus practice. Graham begins his original 1949 discussion of the investor as business owner by pointing out that, in theory, the stockholders as a class are king. Acting as a majority, they can hire and fire managements and bend them completely to their will. But in practice, says Graham, the shareholders are a complete washout. As a class, they show neither intelligence nor alertness. They vote in sheep-like fashion for whatever the management recommends, and no matter how management's record of accomplishment may be. The only way to inspire the average American shareholder to take any independently intelligent action would be by exploding a firecracker under him. We cannot resist pointing out the paradoxical fact that Jesus seems to have been a more practical businessman than our American shareholders. Graham wants you to realize something basic but incredibly profound. When you buy a stock, you become an owner of the company. Its managers, all the way up to the CEO, work for you. Its board of directors must answer to you. Its cash belongs to you. Its businesses are your property. If you don't like how your company is being managed, you have the right to demand that the managers be fired, the directors be changed, or the property be sold. Stockholders, declares Graham, should wake up. 2. The intelligent owner. Today's investors have forgotten Graham's message. They put most of their effort into buying a stock, a little into selling it, but none into owning it. Certainly, Graham reminds us, there's just as much reason to exercise care and judgment in being as in becoming a stockholder. 3. So how should you, as an intelligent investor, go about being an intelligent owner? Graham starts by telling us that there are just two basic questions to which stockholders should turn their attention. 1. Is the management reasonably efficient? 2. Are the interests of the average outside shareholder receiving proper recognition? 4. You should judge the efficiency of management by comparing each company's profitability, size, and competitiveness against similar firms in its industry. What if you conclude that the managers are no good? Then, urges Graham, a few of the more substantial stockholders should become convinced that a change is needed and should be willing to work toward that end. Second, the rank and file of the stockholders should be open-minded enough to read the proxy material and to weigh the arguments on both sides. They must at least be able to know when their company has been unsuccessful and be ready to demand more than artful platitudes as a vindication of the incumbent management. Third, it would be most helpful when the figures clearly show that the results are well below average. If it became the custom to call in outside business engineers to pass upon the policies and competence of the management. The Enron End Run. Back in 1999, Enron Corp. ranked 7th on the Fortune 500 list of America's top companies. The energy giant's revenues, assets, and earnings were all rising like rockets. But what if an investor had ignored the glamour and glittering numbers and had simply put Enron's 1999 proxy statement under the microscope of common sense? Under the heading Certain Transactions, the proxy disclosed that Enron's chief financial officer, Andrew Fastow, was the managing member of two partnerships, LGM1 and LGM2, that bought energy and communications-related investments. And where was LGM1 and LGM2 buying from? Why, where else but from Enron? The proxy reported that the partnerships had already bought $170 million of assets from Enron, sometimes using money borrowed from Enron. The intelligent investor would immediately have asked, did Enron's directors approve this arrangement? Yes, said the proxy. Would Fastow get a piece of LJM's profits? Yes, said the proxy. As Enron's chief financial officer, was Fastow obligated to act exclusively in the interests of Enron's shareholders? Of course. Was Fastow therefore duty-bound to maximize the price Enron obtained for any assets it sold? Absolutely. But if LJM paid a high price for Enron's assets, would that lower LJM's potential profits and Fastow's personal income? Clearly. On the other hand, if LJM paid a low price, would that raise profits for Fastow and his partnerships, but hurt Enron's income? Clearly. Should Enron lend Fastow's partnerships any money to buy assets from Enron that might generate a personal profit for Fastow? Say what? Doesn't all this constitute profoundly disturbing conflicts of interest? No other answer is even possible. What does this arrangement say about the judgment of the directors who approved it? It says you should take your investment dollars elsewhere. Two clear lessons emerge from this disaster. Never dig so deep into the numbers that you check your common sense at the door, and always read the proxy statement before and after you buy a stock. What is proxy material, and why does Graham insist that you read it? In its proxy statement, which it sends to every shareholder, a company announces the agenda for its annual meeting and discloses details about the compensation and stock ownership of managers and directors, along with transactions between insiders and the company. Shareholders are asked to vote on which accounting firm should audit the books and who should serve on the board of directors. If you use your common sense while reading the proxy, this document can be like a canary in a coal mine, an early warning system signaling that something is wrong. See the Enron sidebar above. Yet, on average, between a third and a half of all individual investors cannot be bothered to vote their proxies. Do they even read them? 6. Understanding and voting your proxy is every bit as fundamental to being an intelligent investor as following the news and voting your conscience is to being a good citizen. It doesn't matter whether you own 10% of a company or, with your piddling 100 shares, just 0.10000 of 1%. If you've never read the proxy of a stock you own and the company goes bust, the only person you should blame is yourself. If you do read the proxy and see things that disturb you, then vote against every director to let them know you disapprove for your rights. Attend the annual meeting and speak up. Find an online message board devoted to the stock like those at finance.yahoo.com and rally other investors to join your cause. Graham had another idea that could benefit today's investors. There are advantages to be gained through the selection of one or more professional and independent directors. These should be men of wide business experience who can turn a fresh and expert eye on the problems of the enterprise. They should submit a separate annual report, addressed directly to the stockholders and containing their views on the major question which concerns the owners of the enterprise. Is the business showing the results for the outside stockholder which could be expected of it under proper management? If not, why and what should be done about it? One can only imagine the consternation that Graham's proposal would cause among the corporate cronies and golfing buddies who constitute so many of today's independent directors. Let's not suggest that it might send a shudder of fear down their spines, since most independent directors do not appear to have a backbone. Whose money is it anyway? Now let's look at Graham's second criterion, whether management acts in the best interests of outside investors. Managers have always told shareholders that the managers know best what to do with the company's cash. Graham saw right through this managerial malarkey. A company's management may run the business well and yet not give the outside stockholders the right results for them, because its efficiency is confined to operations and does not extend to the best use of the capital. The objective of efficient operation is to produce at low cost and to find the most profitable articles to sell. Efficient finance requires that the stockholders' money be working in forms most suitable to their interest. This is a question in which management as such has little interest. Actually, it almost always wants as much capital from the owners as it can possibly get in order to minimize its own financial problems. Thus, the typical management will operate with more capital than necessary if the stockholders permit it, which they often do. In the late 1990s and into the early 2000s, the managements of leading technology companies took this as daddy knows best attitude to new extremes. The argument went like this: why should you demand a dividend when we can invest that cash for you and turn it into a rising share price? Just look at the way our stock has been going up. Doesn't that prove that we can turn your pennies into dollars better than you can? Incredibly, investors fell for it hook, line, and sinker. Daddy knows best became such gospel that by 1999, only 3.7% of the companies that first sold their stock to the public that year paid a dividend, down from an average of 72.1% of all IPOs in the 1960s. Just look at how. But Daddy knows best was nothing but bunk. While some companies put their cash to good use, many more fell into two other categories: those that simply wasted it and those that piled it up far faster than they could possibly spend it. In the first group, Priceline.com wrote off $67 million in losses in 2000s after launching goofy ventures into groceries and gasoline, while Amazon.com destroyed at least $233 million of its shareholders' wealth by investing in bombs like Webvan and Ashford.com. And the two biggest losses so far on record, JDS Uniphase's $56 bill, Lion in 2001, and AOL Time Warner's $99 billion in 2002 occurred after companies chose not to pay dividends but to merge with other firms at a time when their shares were obscenely overvalued. In the second group, consider that by late 2001, Oracle Corp had piled up $5 billion in cash. Cisco Systems had hoarded at least $7.5 billion. Microsoft had amassed a mountain of cash, $38.2 billion high, and rising by an average of more than $2 million per hour. 12. Just how rainy a day was Bill Gates expecting anyway? So the anecdotal evidence clearly shows that many companies don't know how to turn excess cash into extra returns. What does the statistical evidence tell us? Research by money managers Robert Arnott and Clifford Asness found that when current dividends are low, future corporate earnings also turn out to be low. And when current dividends are high, so are future earnings over 10-year periods. The average rate of earnings growth was 3.9 points greater when dividends were high than when they were low. 13 Columbia accounting professors Doron Nissim and Amir Ziv found that companies that raise their dividend not only have better stock returns, but that dividend increases are associated with higher future profitability for at least 4 years after the dividend change. 14. In short, most managers are wrong when they say that they can put your cash to better use than you can. Paying out a dividend does not guarantee great results, but it does improve the return of the typical stock by yanking at least some cash out of the manager's hands before they can either squander it or squirrel it away. Selling low, buying high. What about the argument that companies can put spare cash to better use by buying back their own shares? When a company repurchases some of its stock, that reduces the number of its shares outstanding, even if its net income stays flat. the company's earnings. PEASH. ID. TAMTHS per share will rise, since its total earnings will be spread across fewer shares. That in turn should lift the stock price. Better yet, unlike a dividend, a buyback is tax-free to investors who don't sell their shares. 15%, thus it increases the value of their stock without raising their tax bill. And if the shares are cheap, then spending spare cash to repurchase them is an excellent use of the company's capital. 16. All this is true in theory. Unfortunately, in the real world, stock buybacks have come to serve a purpose that can only be described as sinister. Now that grants of stock options have become such a large part of executive compensation, many companies, especially in high-tech industries, must issue hundreds of millions of shares to give to managers who exercise those stock options, but that would jack up the number of shares outstanding and shrink earnings per share. To counteract that dilution, the companies must turn right back around and repurchase millions of shares in the open market. By 2000s, companies were spending an astounding 41.8% of their total net income to repurchase their own shares, up from 4.8% in 1980.18. Let's look at Oracle Corp, the software giant. Between June 1st, 1999 and May 31st, 2000s, Oracle issued 101 million shares of common stock to its senior executives and another 26 million to employees at a cost of $484 million. Meanwhile, to keep the exercise of earlier stock options from diluting its earnings per share, Oracle spent $5.3 billion, or 52% of its total revenues, that year to buy back 290.7 million shares of stock. Oracle issued the stock to insiders at an average price of $3.53 per share and repurchased it at an average price of $18.26. Sell low, buy high? Is this any way to enhance shareholder value? 19. By 2002, Oracle stock had fallen to less than half its peak in 2000s. Now that its shares were cheaper, did Oracle hasten to buy back more stock? Between June 1st, 2001 and May 31st, 2002, Oracle cut its repurchases to $2.8 billion, apparently because its executives and employees exercised fewer options that year. The same sell low, buy high pattern is evident at dozens of other technology companies. What's going on here? Two surprising factors are at work. Dead tick, 20 Corista ACC 21 seconds. Companies get a tax break when executives and employees exercise stock options, which the IRS considers a compensation expense to the company, 20 in its fiscal years from 2000s through 2002, for example. Oracle reaped $1.69 billion in tax benefits as insiders cashed in on options. Sprint Corp pocketed $678 million in tax benefits as its executives and employees locked in 190 bill, Lion and options profits in 1999 and 2000s. A senior executive heavily compensated with stock options has a vested interest in favoring stock buybacks over dividends. Why? For technical reasons, options increase in value as the price fluke. Tuitions of a stock grow more extreme, but dividends dampen the volatility of a stock's price. So if the managers increase the divvy, then they would lower the value of their own stock options. 21. No wonder CEOs would much rather buy back stock than pay diva. Dens, regardless of how overvalued the shares may be or how dross tickleet may waste the resources of the outside shareholders, keeping their options open. Finally, drowsy investors have given their companies free rein to overpay executives in ways that are simply unconscionable. In 1997, Steve Jobs, the co-founder of Apple Computer Inc., returned to the company as its interim chief executive officer. Already a wealthy man, Jobs insisted on taking a cash salary of $1 per year. At year-end 1999, to thank Jobs for serving as CEO for the previous 2.5 years without compensation, the board presented him with his very own Gulfstream jet at a cost to the company of a mere $90 million. The next month, Jobs agreed to drop interim from his job title, and the board rewarded him with options on 20 million shares. Until then, Jobs had held a grand total of 2 shares of Apple stock. The principle behind such option grants is to align the interests of managers with outside investors. If you are an outside Apple shareholder, you want its managers to be rewarded only if Apple stock earns superior returns. Nothing else could possibly be fair to you and the other owners of the company. But as John Bogle, former chairman of the Vanguard Funds, points out, nearly all managers sell the stock they receive immediately after exercising their options. How could dumping millions of shares for an instant profit possibly align their interests with those of the company's loyal long-term shareholders? In Jobs' case, if Apple stock rises by just 5% annually through the beginning of 2010, he will be able to cash in his options for $548.3 million. In other words, even if Apple stock earns no better than half the long-term average return of the overall stock market, Jobs will land a $500 million windfall. 22, does that align his interests with those of Apple's shareholders or malign the trust that Apple shareholders have placed in the board of directors? Reading proxy statements vigilantly, the intelligent owner will vote against any executive compensation plan that uses option grants to turn more than 3% of the company's shares outstanding over to the managers. And you should veto any plan that does not make option grants contingent on a fair and enduring measure of superior results. Say outperforming the average stock in the same industry for a period of at least 5 years. No CEO ever deserves to make himself rich if he has produced poor results for you. A final thought. Let's go back to Graham's suggestion that every company's independent board members should have to report to the shareholders in writing on whether the business is properly managed on behalf of its true owners. What if the independent directors also had to justify the company's policies on dividends and share repurchases? What if they had to describe exactly how they determined that the company's senior management was not overpaid? And what if every investor became an intelligent owner and actually read that report? Chapter 20, Margin of Safety as a Central Concept of Investment. 11 Con. In the old legend, the wise men finally boiled down the history of mortal affairs into the single phrase, "This too will pass." Fronted with a like challenge to distill the secret of sound investment to 3 words, we venture the motto, margin of safety. This is the thread that runs through all the preceding discussion of investment policy, often explicitly, sometimes in a less direct fashion. Let us try now briefly to trace that idea in a connected argument. All experienced investors recognize that the margin of safety concept is essential to the choice of sound bonds and preferred stocks. For example, a railroad should have earned its total fixed charges better than 5 times before income tax, taking a period of years for its bonds to qualify as investment-grade issues. This past ability to earn in excess of interest requirements constitutes a margin of safety that is counted on to protect the investor against loss or discomfiture in the event of some future decline in net income. The margin above charges may be stated in other ways. For example, in the percentage by which revenues or profits may decline before the balance after interest disappears. But the underlying idea remains the same. The bond investor does not expect future average earnings to work out the same as in the past. If he were sure of that, the margin demanded might be small. Nor does he rely to any controlling extent on his judgment as to whether future earnings will be materially better or poorer than in the past. If he did that, he would have to measure his margin in terms of a carefully projected income account instead of emphasizing the margin shown in the past. Record. Here, the function of the margin of safety is in essence that of rendering unnecessary an accurate estimate of the future. If the margin is a large one, then it is enough to assume that future earnings will not fall far below those of the past in order for an investor to feel sufficiently protected against the vicissitudes of time. The margin of safety for bonds may be calculated alternatively by comparing the total value of the enterprise with the amount of debt. A similar calculation may be made for a preferred stock issue. If the business owes $10 million and is fairly worth $30 million, there is room for a shrinkage of 2/3 in value, at least theoretically, before the bondholders will suffer loss. The amount of this extra value, or cushion, above the debt may be approximated by using the average market price of the junior stock issues over a period of years. Since average stock prices are generally related to average earning power, the margin of enterprise value over debt and the margin of earnings over charges will in most cases yield similar results. So much for the margin of safety concept as applied to fixed value investments. Can it be carried over into the field of common stocks? Yes, but with some necessary modifications. There are instances where a common stock may be considered sound because it enjoys a margin of safety as large as that of a good bond. This will occur, for example, when a company has outstanding only common stock that under depression conditions is selling for less than the amount of bonds that could safely be issued against its property and earning power. That was the position of a host of strongly financed industrial companies at the low price levels of 1932 to 33. In such instances, the investor can obtain the margin of safety associated with the bond, plus all the chances of larger income and principal appreciation inherent in a common stock. The only thing he lacks is the legal power to insist on dividend payments or else, but this is a small drawback as compared with his advantages. Common stocks bought under such circumstances will supply an ideal, though infrequent, combination of safety and profit opportunity. As a quite recent example of this condition, let us mention once more National Presto Industries stock, which sold for a total enterprise value of $43 million in 1972. With its $16 million of recent earnings before taxes, the company could easily have supported this amount of bonds. In the ordinary common stock bought for investment under normal conditions, the margin of safety lies in an expected earning power considerably above the going rate for bonds. In former editions, we elucidated this point with the following figures. Assume in a typical case that the earning power is 9% on the price and that the bond rate is 4%. Then the stock buyer will have an average annual margin of 5% accruing in his favor. Some of the excess is paid to him in the dividend rate. Even though spent by him, it enters into his overall investment result. The undistributed balance is reinvested in the business for his account. In many cases, such reinvested earnings fail to add commensurately to the earning power and value of his stock. That is why the market has a stubborn habit of valuing earnings dispersed in dividends more generously than the portion retained in the business. But if the picture is viewed as a whole, there is a reasonably close connection between the growth of corporate surpluses through reinvested earnings and the growth of corporate values. Over a 10-year period, the typical excess of stock earning power over bond interest may aggregate 50% of the price paid. This figure is sufficient to provide a very real margin of safety which, under favorable conditions, will prevent or minimize a loss. If such a margin is present in each of a diversified list of 20 or more stocks, the probability of a favorable result under fairly normal conditions becomes very large. That is why the policy of investing in representative common stocks does not require high qualities of insight and foresight to work out successfully. If the purchases are made at the average level of the market over a span of years, the prices paid should carry with them assurance of an adequate margin of safety. The danger to investors lies in concentrating their purchases in the upper levels of the market, or in buying non-representative common stocks that carry more than average risk of diminished earning power. Under 1972 conditions lies in the fact that, in a typical case, as we see it, the whole problem of common stock investment, earning power is now much less than 9% on the price paid. Leadus. Assume that by concentrating somewhat on the low multiplier issues among the large companies, a defensive investor may now acquire equities at 12 times recent earnings, i.e., with an earnings return of 8.33% on cost. He may obtain a dividend yield of about 4%, and he will have 4.33% of his costs reinvested in the business for his account. On this basis, the excess of stock earning power over bond interest over a 10-year basis would still be too small to constitute an adequate margin of safety. For that reason, we feel that there are real risks now, even in a diversified list of sound common stocks. The risks may be fully offset by the profit possibilities of the list, and indeed the investor may have no choice but to incur them, for otherwise he may run an even greater risk of holding only fixed claims payable in steadily depreciating dollars. Nonetheless, the investor would do well to recognize and to accept as philosophically as he can that the old package of good profit possibilities combined with small ultimate risk is no longer available to him. However, the risk of paying too high a price for good quality stocks, while a real one, is not the chief hazard confronting the average buyer of securities. Observation over many years has taught us that the chief losses to investors come from the purchase of low-quality securities at times of favorable business conditions. The purchasers view the current good earnings as equivalent to earning power and assume that prosperity is synonymous with safety. It is in those years that bonds and preferred stocks of inferior grade can be sold to the public at a price around par, because they carry a little higher income return or a deceptively attractive conversion privilege. It is then also that common stocks of obscure companies can be floated at prices far above the tangible investment on the strength of 2 or 3 years of excellent growth. These securities do not offer an adequate margin of safety in any admissible sense of the term. Coverage of interest charges and preferred dividends must be tested over a number of years, including preferably a period of subnormal business such as in 1970 to 71. The same is ordinarily true of common stock earnings if they are too qualified as indicators of earning power. Thus, it follows that most of the fair weather investments acquired at fair weather prices are destined to suffer disturbing price declines when the horizon clouds over, and often sooner than that. Nor can the investor count with confidence on an eventual recovery, although this does come about in some proportion of the cases, for he has never had a real safety margin to tide him through adversity. The philosophy of investment in growth stocks parallels in part contravenes the margin of safety principle. The growth stock buyer relies on an expected earning power that is greater than the average shown in the past. Thus, he may be said to substitute these expected earnings for the past record in calculating his margin of safety. In investment theory, there is no reason why carefully estimated future earnings should be a less reliable guide than the bare record of the past. In fact, security analysis is coming more and more to prefer a competently executed evaluation of the future. Thus, the growth stock approach may supply as dependable a margin of safety as is found in the ordinary investment, provided the calculation of the future is conservatively made, and provided it shows a satisfactory margin in relation to the price paid. The danger in a growth stock program lies precisely here. For such favored issues, the market has a tendency to set prices that will not be adequately protected by a conservative projection of future earnings. It is a basic rule of prudent investment that all estimates, when they differ from past performance, must err at least slightly on the side of understatement. The margin of safety is always dependent on the price paid. It will be large at one price, small at some higher price, non-existent at some still higher price. If, as we suggest, the average market level of most growth stocks is too high to provide an adequate margin of safety for the buyer, then a simple technique of diversified buying in this field may not work out satisfactorily. A special degree of foresight and judgment will be needed, in order that wise individual selections may overcome the hazards inherent in the customary market level of such issues as a whole. The margin of safety idea becomes much more evident when we apply it to the field of undervalued or bargain securities. We have here, by definition, a favorable difference between price on the one hand and indicated or appraised value on the other. That difference is the safety margin. It is available for absorbing the effect of miscalculations, or worse, than average luck. The buyer of bargain issues places particular emphasis on the ability of the investment to withstand adverse developments, for in most such cases he has no real enthusiasm about the company's prospects. True, if the prospects are definitely bad, the investor will prefer to avoid the security no matter how low the price. But the field of undervalued issues is drawn from the many concerns. Perhaps a majority of the total for which the future appears neither distinctly promising nor distinctly unpromising. If these are bought on a bargain basis, even a moderate decline in the earning power need not prevent the investment from showing satisfactory results. The margin of safety will then have served its proper purpose. Theory of diversification: there is a close logical connection between the concept of a safety margin and the principle of diversification. One is correlative with the other. Even with a margin in the investor's favor, an individual security may work out badly, for the margin guarantees only that he has a better chance for profit than for loss, not that loss is impossible. But as the number of such commitments is increased, the more certain does it become that the aggregate of the profits will exceed the aggregate of the losses. That is the simple basis of the insurance underwriting business. Diversification is an established tenet of conservative investment. By accepting it so universally, investors are really demonstrating their acceptance of the margin of safety principle, to which diversification is the companion. This point may be made more colorful by a reference to the arithmetic of roulette. If a man bets $1 on a single number, he is paid $35 profit when he wins, but the chances are 37 to 1 that he will lose. He has a negative margin of safety. In his case, diversification is foolish. The more numbers he bets on, the smaller his chance of ending with a profit. If he largely bets $1 on every number, including 0 and 000, he is certain to lose $2 on each turn of the wheel. But suppose the winner received $39 profit instead of $35. Then he would have a small but important margin of safety. Therefore, the more numbers he wagers on, the better his chance of gain. and he could be certain of winning $2 on every spin by simply betting $1 each on all the numbers. Incidentally, the two examples given actually describe the respective positions of the player and proprietor of a wheel with zero. And a criterion of investment versus speculation, since there is no single definition of investment in general acceptance, authorities have the right to define it pretty much as they please. Many of them deny that there is any useful or dependable difference between the concepts of investment and of speculation. We think this skepticism is unnecessary and harmful. It is injurious because it lends encouragement to the innate leaning of many people toward the excitement and hazards of stock, market, speculation. We suggest that the margin of safety concept may be used to advantage as the touchstone to distinguish an investment operation from a speculative one. Probably most speculators believe they have the odds in their favor when they take their chances, and therefore they may lay claim to a safety margin in their proceedings. Each one has the feeling that the time is propitious for his purchase, or that his skill is superior to the crowd's, or that his advisor or system is trustworthy. But such claims are unconvincing. They rest on subjective judgment, unsupported by any body of favorable evidence or any conclusive line of reasoning. We greatly doubt whether the man who stakes money on his view that the market is heading up or down can ever be said to be protected by a margin of safety in any useful sense of the phrase. By contrast, the investor's concept of the margin of safety, as developed earlier in this chapter, rests upon simple and definite arithmetical reasoning from statistical data. We believe also that it is well supported by practical investment experience. There is no guarantee that this fundamental quantitative approach will continue to show favorable results under the unknown conditions of the future, but equally, there is no valid reason for pessimism on this score. Thus, in sum, we say that to have a true investment, there must be present a true margin of safety. And a true margin of safety is one that can be demonstrated by figures, by persuasive reasoning, and by reference to a body of actual experience. Extension of the concept of investment. To complete our discussion of the margin of safety principle, we must now make a further distinction between conventional and unconventional investments. Conventional investments are appropriate for the typical portfolio. Under this heading have always come United States government issues and high-grade, dividend-paying common stocks. We have added state and municipal bonds for those who will benefit sufficiently by their tax-exempt features. Also included are first-quality corporate bonds when, as now, they can be bought to yield sufficiently more than United States savings. Bonds. Unconventional investments are those that are suitable only for the enterprising investor. They cover a wide range. The broadest category is that of undervalued common stocks of secondary pennies, which we recommend for purchase when they can be bought at 2/3 or less of their indicated value. Besides these, there is often a wide choice of medium-grade corporate bonds and preferred stocks when they are selling at such depressed prices as to be obtainable also at a considerable discount from their apparent value. In these cases, the average investor would be inclined to call the security speculative, because in his mind their lack of a first quality rating is synonymous with a lack of investment merit. It is our argument that a sufficiently low price can turn a security of mediocre quality into a sound investment opportunity provided that the buyer is informed and experienced and that he practices adequate diversification. For if the price is low enough to create a substantial margin of safety, the security thereby meets our criterion of investment. Our favorite supporting illustration is taken from the field of real estate bonds. In the 1920s, billions of dollars worth of these issues were sold at par and widely recommended as sound investments. A large proportion had so little margin of value over debt as to be in fact highly speculative in character. In the Depression of the 1930s, an enormous quantity of these bonds defaulted their interest and their price collapsed, in some cases below 10 cents on the dollar. At that stage, the same advisors who had recommended them at par as safe investments were rejecting them as paper of the most speculative and unattractive type. But as a matter of fact, the price depreciation of about 90% made many of these securities exceedingly attractive and reasonably safe, for the true values behind them were 4 or 5 times the market quotation. The fact that the purchase of these bonds actually resulted in what is generally called a large speculative profit did not prevent them from having true investment qualities at their low prices. The speculative profit was the purchaser's reward for having made an unusually shrewd investment. They could properly be called investment opportunities, since a careful analysis would have shown that the excess of value over price provided a large margin of safety. Thus, the very class of fair weather investments, which we stated above as a chief source of serious loss to naive security buyers, is likely to afford many sound profit opportunities to the sophisticated operator, who may buy them later at pretty much his own price. T. The whole field of special situations would come under our definition of investment operations, because the purchase is always predicated on a thoroughgoing analysis that promises a larger realization than the price paid. Again, there are risk factors in each individual case, but these are allowed for in the calculations and absorbed in the overall results of a diversified operation. To carry this discussion to a logical extreme, we might suggest that a defensible investment operation could be set up by buying such intangible values as are represented by a group of common stock option warrants selling at historically low prices. This example is intended as somewhat of a shocker. The entire value of these warrants rests on the possibility that the related stocks may someday advance above the option price. At the moment, they have no exercisable value. Yet, since all investment rests on reasonable future expectations, it is proper to view these warrants in terms of the mathematical chances that some future bull market will create a large increase in their indicated value and in their price. Such a study might well yield the conclusion that there is much more to be gained in such an operation than to be lost, and that the chances of an ultimate profit are much better than those of an ultimate loss. If that is so, there is a safety margin present even in this unprepossessing security form. A sufficiently enterprising investor could then include an option warrant operation in his miscellany of unconventional investments. 1. To sum up, investment is most intelligent when it is most businesslike. It is amazing to see how many capable businessmen try to operate in Wall Street with complete disregard of all the sound principles through which they have gained success in their own undertakings. Yet every corporate security may best be viewed, in the first instance, as an ownership interest in or a claim against a specific business enterprise. And if a person sets out to make profits from security purchases and sales, he is embarking on a business venture of his own, which must be run in accordance with accepted business principles if it is to have a chance of success. The first and most obvious of these principles is, know what you are doing, know your business. For the investor, this means do not try to make business profits out of securities, that is, returns in excess of normal interest and dividend income, unless you know as much about security values as you would need to know about the value of merchandise that you propose to manufacture or deal in. A second business principle, do not let anyone else run your business, unless 1, you can supervise his performance with adequate care and comprehension, or 2, you have unusually strong reasons for placing implicit confidence in his integrity and ability. For the investor, this rule should determine the conditions under which he will permit someone else to decide what is done with his money. A third business principle, do not enter upon an operation, that is, manufacturing or trading in an item unless a reliable calculation shows that it has a fair chance to yield a reasonable profit. In particular, keep away from ventures in which you have little to gain and much to lose. For the enterprising investor, this means that his operations for profit should be based not on optimism, but on arithmetic. For every investor, it means that when he limits his return to a small figure, as formerly at least in a conventional bond or preferred stock, he must demand convincing evidence that he is not risking a substantial part of his principal. A fourth business rule is more positive. Have the courage of your knowledge and experience. If you have formed a conclusion from the facts, and if you know your judgment is sound, act on it even though others may hesitate or differ. You are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. Similarly, in the world of securities, courage becomes the supreme virtue after adequate knowledge and a tested judgment are at hand. Fortunately for the typical investor, it is by no means necessary for his success that he bring these qualities to bear upon his program, provided he limits his ambition to his capacity and confines his activities within the safe and narrow path of standard defensive investment. To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. Commentary on chapter 20. If we fail to anticipate the unforeseen or expect the unexpected in a universe of infinite possibilities, we may find ourselves at the mercy of anyone or anything that cannot be programmed, categorized, or easily referenced. Agent Fox Mulder, The X-Files. First, don't lose what is risk. You'll get different answers depending on whom and when you ask. In 1999, risk didn't mean losing money. It meant making less money than someone else. What many people feared was bumping into somebody at a barbecue who was getting even richer even quicker by day trading.com stocks than they were. Then, quite suddenly, by 2003, risk had come to mean that the stock market might keep dropping until it wiped out whatever traces of wealth you still had left. While its meaning may seem nearly as fickle and fluctuating as the financial markets themselves, risk has some profound and permanent attributes. The people who take the biggest gambles and make the biggest gains in a bull market are almost always the ones who get hurt the worst in the bear market that inevitably follows. Being right makes speculators even more eager to take extra risk as their confidence catches fire. And once you lose big money, you then have to gamble even harder just to get back to where you were, like a racetrack or casino gambler who desperately doubles up after every bad bet. Unless you are phenomenally lucky, that's a recipe for disaster. No wonder, when he was asked to sum up everything he had learned in his long career about how to get rich, the legendary financier J.K. Bollickley, in With Strips Graham's Pay To, Our Wealth, W.I. Kanziji di Sunionera, totaled $153 $143 SB1 DUA's faced TH Figu 15%, 10%. Imagine that you find a stock that you think can grow at 10% a year, even if the market only grows 5% annually. Unfortunately, you are so enthusiastic, you pay too high a price, and the stock loses 50% of its value the first year. Even if the stock then generates double the market's return, it will take you more than 16 years to overtake the market simply because you paid too much and lost too much at the outset. That must. Losing some money is an inevitable part of investing, and there's nothing you can do to prevent it. But to be an intelligent investor, you take responsibility for ensuring that you never lose most or all of your money. The Hindu goddess of wealth, Lakshmi, is often portrayed standing on tiptoe, ready to dart away in the blink of an eye. To keep her sim, 15%, average annual rates of 20%, 259, 30, 040, DSC. Bollickley in place, some of Lakshmi's devotees will lash her statue down with strips of fabric or nail its feet to the floor. For the intelligent investor, Graham's margin of safety performs the same function. By refusing to pay too much for an investment, you minimize the chances that your wealth will ever disappear or suddenly be destroyed. Consider this. Over the 4 quarters ending in December 1999, JDS Uniphase Corp., the fiber optics company, generated $673 million in net sales, on which it lost $313 million. Its tangible assets totaled $1.5 billion. Yet, on March 7, 2000s, JDS Uniphase's stock hit $153 a share, giving the company a total market value of roughly $143 billion. And then, like most new era stocks, it crashed. Anyone who bought it that day and still clung to it at the end of 2002 faced these prospects. Even at a robust 10% annual rate of return, it will take more than 43 years to break even on this overpriced purchase. The risk is not in our stocks, but in ourselves. Risk exists in another dimension, inside you. If you overestimate how well you really understand an investment or overstate your ability to ride out a temporary plunge in prices, doesn't matter what you own or how the market does. Ultimately, financial risk resides not in what kinds of investments you have, but in what kind of investor you are. If you want to know what risk really is, go to the nearest bathroom and step up to the mirror. That's risk, gazing back at you from the glass. As you look at yourself in the mirror, what should you watch for? The Nobel Prize-winning psychologist Daniel Kahneman explains 2 factors that characterize good decisions: well-calibrated confidence, do I understand this investment as well as I think I do? Correctly anticipated regret, how will I react if my analysis turns out to be wrong? To find out whether your confidence is well-calibrated, look in the mirror and ask yourself, what is the likelihood that my analysis is right? Think carefully through these questions. How much experience do I have? What is my track record with similar decisions in the past? What is the typical track record of other people who have tried this in the past? 3, if I am buying, someone else is selling. How likely is it that I know something that this other person or company does not know? If I am selling, someone else is buying. How likely is it that I know something that this other person or company does not know? Have I calculated how much this investment needs to go up for me to break even after my taxes and costs of trading? Next, look in the mirror to find out whether you are the kind of person who correctly anticipates your regret. Start by asking, do I fully understand the consequences if my analysis turns out to be wrong? Answer that question by considering these points. If I'm right, I could make a lot of money. But what if I'm wrong? Based on the historical performance of similar investments, how much could I lose? Do I have other investments that will tide me over if this decision turns out to be wrong? Do I already hold stocks, bonds, or funds with a proven record of going up when the kind of investment I'm considering goes down? Am I putting too much of my capital at risk with this new investment? When I tell myself, you have a high tolerance for risk, how do I know? Have I ever lost a lot of money on an investment? How did it feel? Did I buy more or did I bail out? Am I relying on my willpower alone to prevent me from panicking at the wrong time? Or have I controlled my own behavior in advance by diversifying, signing an investment contract, and dollar cost averaging? You should always remember, in the words of the psychologist Paul Slovic, that risk is brewed from an equal dose of two ingredients, probabilities, and consequences. Before you invest, you must ensure that you have realistically assessed your probability of being right and how you will react to the consequences of being wrong. Pascal's wager, the investment philosopher, Peter Bernstein has another way awesome. Ming this up, he reaches back to Blaise Pascal, the great French mathematician and theologian, 1623 to 1662, who created a thought experiment in which an agnostic must gamble on whether or not God exists. The ante this person must put up for the wager is his conduct in this life. The ultimate payoff in the gamble is the fate of his soul in the afterlife. In this wager, Pascal asserts, reason cannot decide the probability of God's existence. Either God exists or he does not, and only faith, not reason, can answer that question. But while the probabilities in Pascal's wager are a toss-up, the consequences are perfectly clear and utterly certain. As Bernstein explains, suppose you act as though God is and you lead a life of virtue and abstinence, when in fact there is no God. You will have passed up some goodies in life, but there will be rewards as well. Now suppose you act as though God is not and spend a life of sin, selfishness, and lust when in fact God is. You may have had fun and thrills during the relatively brief duration of your lifetime, but when the day of judgment rolls around, you are in big trouble. 5. Concludes Bernstein, in making decisions under conditions of uncertainty, the consequences must dominate the probabilities. We never know the future. Thus, as Graham has reminded you in every chapter of this book, the intelligent investor must focus not just on getting the analysis right. You must also insure against loss if your analysis turns out to be wrong, as even the best analyses will be at least some of the time. The probability of making at least one mistake at some point in your investing lifetime is virtually 100%, and those odds are entirely out of your control. However, you do have control over the consequences of being wrong. Many investors put essentially all of their money into .com stocks in 1999, an online survey of 338 Americans by Money Magazine in 1999 found that nearly 1/10 of them had at least 85% of their money in internet stocks. By ignoring Graham's call for a margin of safety, these people took the wrong S of Pascal's wager, certain that they knew the probabilities of being right. They did nothing to protect themselves against the consequences of being wrong. Simply by keeping your holdings permanently diversified and refusing to fling money at Mr. Market's latest, craziest fashions, you can ensure that the consequences of your mistakes will never be catastrophic. No matter what Mr. Market throws at you, you will always be able to say with a quiet confidence, this too shall pass away. Postscript, we know very well two partners who spent a good part of their lives handling their own and other people's funds on Wall Street. Some hard experience taught them it was better to be safe and careful rather than to try to make all the money in the world. They established a rather unique approach to security operations which combined good profit possibilities with sound values. They avoided anything that appeared overpriced and were rather too quick to dispose of issues that had advanced to levels they deemed no longer attractive. Their portfolio was always well diversified, with more than 100 different issues represented. In this way, they did quite well through many years of ups and downs in the general market. They averaged about 20% per annum on the several millions of capital they had accepted for management, and their clients were well pleased with the results. In the year in which the first edition of this book appeared, an opportunity was offered to the Partners Fund to purchase a half interest in a growing enterprise. For some reason, the industry did not have Wall Street appeal at the time, and the deal had been turned down by quite a few important houses. But the pair was impressed by the company's possibilities, What was decisive for them was that the price was moderate in relation to current earnings and asset value. The partners went ahead with the acquisition, amounting in dollars to about 1/5 of their fund. They became closely identi, fied with new business interests, which prospered. In fact, it did so well that the price of its shares advanced to 200 times or more the price paid for the half interest. The advance far outstripped the actual growth in profits, and almost from the start, the quotation appeared much too high in terms of the partners' own investment standards. But since they regarded the company as a sort of family business, they continued to maintain a substantial ownership of the shares despite the spectacular price rise. A large number of participants in their funds did the same, and they became millionaires through their holding in this one enterprise, plus later organized affiliates, ironically enough. The aggregate of profits accruing from the single investment decision far exceeded the sum of all the others. Realized through 20 years of wide-ranging operations in the partners' specialized fields, involving much investigation, endless pondering, and countless individual decisions. Are there morals to this story of value to the intelligent investor? An obvious one is that there are several different ways to make and keep money in Wall Street. Another, not so obvious, is that one lucky break or one supremely shrewd decision, can we tell them apart, may count for more than a lifetime of journeyman efforts. But behind the luck or the crucial decision, there must usually exist a background of preparation and discipline capacity. One needs to be sufficiently established and recognized so that opportunities will knock at his particular door. One must, these, have the means, the judgment, and the courage to take advantage of them. Of course, we cannot promise a like spectacular experience to all intelligent investors who remain both prudent and alert through the years. We are not going to end with J.J. Raskov's slogan that we made fun of at the beginning. Everybody can be rich, but interesting possibilities abound on the financial scene, and the intelligent and enterprising investor should be able to find both enjoyment and profit in this three-ring circus. Excitement is guaranteed. Commentary on postscript. Successful investing is about managing risk, not avoiding it. At first glance, when you realize that Graham put 25% of his fund into a single stock, you might think he was gambling rashly with his investors' money. But then, when you discover that Graham had painstakingly established that he could liquidate Geico for at least what he paid for it, it becomes clear that Graham was taking very little financial risk. But he needed enormous courage to take the psychological risk of such a big bet on so unknown a stock. And today's headlines are full of fearful facts and unresolved risks. The death of the 1990s bull market, sluggish economic growth, corporate fraud, the specters of terrorism and war. Investors don't like uncertainty. A market strategist is intoning right now on financial TV or in today's newspaper. But investors have never liked uncertainty, and yet it is the most fundamental and enduring condition of the investing world. It always has been, and it always will be. At heart, uncertainty and investing are synonyms. In the real world, no one has ever been given the ability to see that any particular time is the best time to buy stocks. Without a saving faith in the future, no one would ever invest at all. To be an investor, you must be a believer in a better tomorrow. The most literate of investors, Graham loved the story of Ulysses, told through the poetry of Homer, Alfred Tennyson, and Dante. Late in his life, Graham relished the scene in Dante's Inferno when Ulysses describes inspiring his crew to sail westward into the unknown waters, beyond the gates of Hercules. "O brothers," I said, "who after 100,000 perils have reached the west, in this little waking vigil that still remains to our senses, let us not choose to avoid the experience of the unpeopled world that lies behind the sun. Consider the seeds from which you sprang. You were made not to live like beasts, but to seek virtue and understanding." With this little oration, I made my shipmates so eager for the voyage that it would have hurt to hold them back. And we swung our stern toward the morning and turned our oars into wings for the wild flight. Too. Investing, too, is an adventure. The financial future is always an uncharted world. With Graham as your guide, your lifelong investing voyage should be as safe and confident as it is adventurous. Appendixes 1. The Super Investors of Graham and Doddsville by Warren E. Buffett. Editor's note. This article is an edited transcript of a talk given at Columbia University in 1984 commemorating the 50th anniversary of security analysis, written by Benjamin Graham and David L. Dodd. This specialized volume first introduced the ideas later popularized in The Intelligent Investor. Buffett's essay offers a fascinating study of how Graham's disciples have used Graham's value investing approach to realize phenomenal success in the stock market. Is that Graham and Dodd look for values with a significant margin of safety relative to Price's approach to security analysis out of date? Many of the professors who write textbooks today say yes. They argue that the stock market is efficient, that is, that stock prices reflect everything that is known about a company's prospects and about the state of the economy. There are no undervalued stocks, these theorists argue, because there are smart security analysts who utilize all available information to ensure unfailingly appropriate prices. Investors who seem to beat the market year after year are just lucky. If prices fully reflect available information, this sort of investment adeptness is ruled out, writes one of today's textbook authors. Well, maybe. But I want to present to you a group of investors who have, year in and year out, beaten the Standard & Poor's 500 stock index. The hypothesis that they do this by pure chance is at least worth examining. Crucial to this examination is the fact that these winners were all well known to me and pre-identified as superior investors, the most recent identification occurring over 15 years ago. Absent this condition, that is, if I had just recently searched among thousands of records to select a few names for you this morning, I would advise you to stop reading right here. First should add that all these records have been audited. And I should further add that I have known many of those who have invested with these managers, and the checks received by those participants over the years have matched the stated records. Before we begin this examination, I would like you to imagine a national coin flipping contest. Let's assume we get 225 million Americans up tomorrow morning and we ask them all to wager $1. They go out in the morning at sunrise and they all call the flip of a coin. If they call correctly, they win $1 from those who called wrong. Each day, the losers drop out, and on the subsequent day, the stakes build as all previous winnings are put on the line. After 10 flips on 10 mornings, there will be approximately 220,000 people in the United States who have correctly called 10 flips in a row. They each will have won a little over $1,000. Now, this group will probably start getting a little puffed up about this, human nature being what it is. They may try to be modest, but at cocktail parties they will occasionally admit to attractive members of the opposite sex what their technique is and what marvelous insights they bring to the field of flipping, assuming that the winners are getting the appropriate rewards from the losers. In another 10 days, we will have 215 people who have successfully called their coin flips 20 times in a row and who, by this exercise, each have turned $1 into a little over $1 million. $225 million would have been lost. $225 million would have been won. By then, this group will really lose their heads. They will probably write books on how I turned $1 into a million in 20 days, working 30 seconds a morning. Worse yet, they'll probably start jetting around the country, attending seminars on efficient coin flipping and tackling skeptical professors with, if it can't be done, why are there 215 of us? But then some business school professor will probably be rude enough to bring up the fact that if 225 million orangutans had engaged in a similar exercise, the results would be much the same 215 egotistical orangutans with 20 straight winning flips. I would argue, however, that there are some important differences in the examples I am going to present. For one thing, if AEU had taken 225 million orangutans distributed roughly as the US population is, if B 215 winners were left after 20 days, and if C you found that 40% came from a particular zoo in Omaha, you would be pretty sure you were onto something. So you would probably go out and ask the zookeeper about what he's feeding them, whether they had special exercises, what books they read, and who knows what else. That is, if you found any really extraordinary concentrations of success, you might want to see if you could identify concentrations of unusual characteristics that might be causal factors. Scientific inquiry naturally follows such a pattern. If you were trying to analyze possible causes of a rare type of cancer with, say, 500 cases a year in the United States, and you found that 400 of them occurred in some little mining town in Montana, you would get very interested in the water there, or the occupation of those afflicted or other variables. You know that it's not random. Chance that 400 come from a small area. You would not necessarily know the causal factors, but you would know where to search. I submit to you that there are ways of defining an origin other than geography. In addition to geographical origins, there can be what I call an intellectual origin. I think you will find that a disproportionate number of successful coin flippers in the investment world came from a very small intellectual village that could be called Graham and Doddsville. A concentration of winners that simply cannot be explained by chance can be traced to this particular intellectual village. Conditions could exist that would make even that concentration unimportant. Perhaps 100 people were simply imitating the coin. Flipping calls some terribly persuasive personality. When he called heads, 100 followers automatically called that coin the same way. If the leader was part of the 215 left at the end, the fact that 100% came from the same intellectual origin would mean nothing. You would simply be identifying one case as 100 cases. Similarly, let's assume that you lived in a strongly patriarchal society, and every family in the United States conveniently consisted often members. Further assume that the patriarchal culture was so strong that when the 225 million people went out the first day, every member of the family identified with the father's call. Now, at the end of the 20-day period, you would have 215 winners, and you would find that they came from only 21.5 families. Some naive types might say that this indicates an enormous hereditary factor as an explanation of successful coin flipping. But of course it would have no significance at all, because it would simply mean that you didn't have 215 individual winners, but rather 21.5 randomly distributed families who were winners. In this group of successful investors that I want to consider, there has been a common intellectual patriarch, Ben Graham. But the children who left the house of this intellectual patriarch have called their flips in very different ways. They have gone to differ on places and bought and sold different stocks and companies, yet they have had a combined record that simply can't be explained by random chance. It certainly cannot be explained by the fact that they are all calling flips identically because a leader is signaling the calls to make. The patriarch has merely set forth the intellectual theory for making coin-calling decisions, but each student has decided on his own manner of applying the theory. The common intellectual theme of the investors from Graham and Doddsville is this: they search for discrepancies between the value of a business and the price of small pieces of that business in the market. Essentially, they exploit those discrepancies without the efficient market theorist's concern as to whether the stocks are bought on Monday or Thursday, or whether it is January or July, etc. Incidentally, when businessmen buy businesses, which is just what our Graham and Dodd investors are doing through the medium of marketable stocks, I doubt that many are cranking into their purchase decision the day of the week or the month in which the transaction is going to occur. If it doesn't make difference whether all of a business is being bought on a Monday or any diff. Friday, I am baffled why academicians invest extensive time and effort to see whether it makes a difference when buying small pieces of those same businesses. Our Graham and Dodd investors, needless to say, do not discuss beta, the capital asset pricing model, or covariance in returns among securities. These are not subjects of any interest to them. In fact, most of them would have difficulty defining those terms. The investors simply focus on two variables: price and value. I always find it extraordinary that so many studies are made of price and volume behavior, the stuff of chartists. Can you imagine buying an entire business simply because the price of the business had been marked up substantially last week and the week before? Of course, the reason a lot of studies are made of these price and volume variables is that now, in the age of computers, there are almost endless data available about them. It isn't necessarily because such studies have any utility. It's simply that the data are there, and academicians have worked hard to learn the mathematical skills needed to manipulate them. Once these skills are acquired, it seems sinful not to use them, even if the usage has no utility or negative utility. As a friend said, to a man with a hammer, everything looks like a nail. I think the group that we have identified by a common intellectual home is worthy of study. Incidentally, despite all the academic studies of the influence of such variables as price, volume, seasonality, capitalization size, etc. upon stock performance, no interest has been evidenced in studying the methods of this unusual concentration of value-oriented winners. Names from among. I begin the study of results by going back to a group of 4 of us who worked at Graham-Newman Corporation from 1954 through 1956. There were only 4. I have not selected these. Thousands. I offered to go to work at Graham-Newman for nothing after I took Ben Graham's class, but he turned me down as overvalued. He took this value stuff very seriously. After much pestering, he finally hired me. There were 3 partners and 4 of us at the peasant level. All 4 left between 1955 and 1957 when the firm was wound up, and it's possible to trace the record of 3. The first example, see Table 1, pages 549-550, is that of Walter Schloss. Walter never went to college, but took a course from Ben Graham at night at the New York Institute of Finance. Walter left Graham Newman in 1955 and achieved the record shown here over 28 years. Here's what Adam Smith, after I told him about Walter, wrote about him in Super Money in 1972. He has no connections or access to useful information. Practically, no one in Wall Street knows him, and he is not fed any ideas. He looks up the numbers in the manuals and sends for the annual reports, and that's about it. In introducing me to Schloss Warren had also, to my mind, described himself. He never forgets that he is handling other people's money, and this reinforces his normal strong aversion. 2. Loss. He has total integrity and a realistic picture of himself. Money is real to him and stocks are real, and from this flows N. Attraction to the margin of safety principle. Walter has diversified enormously, owning well over 100 stocks currently. He knows how to identify securities that sell at considerably less than their value to a private owner. And that's all he does. He doesn't worry about whether it's January. He doesn't worry about whether it's Monday. He doesn't worry about whether it's an election year. He simply says, if a business is worth $1 and I can buy for 40 cents, something good may happen to me. And he does it over and over and over again. He owns many more stocks than I do and is far less interested in the underlying nature of the business. I don't seem to have very much influence on Walter. That's one of his strengths. No one has much influence on him. The second case is Tom Knapp, who also worked at Graham Newman with me. Tom was a chemistry major at Princeton before the war. When he came back from the war, he was a beach bum. And then one day he read that Dave Dodd was giving a night course in investments at Columbia. Tom took it on a non-credit basis, and he got so interested in the subject from taking that course that he came up and enrolled at Columbia Business School, where he got the MBA degree. He took Dodd's course again and took Ben Graham's course. Incidentally, 35 years later, I called Tom to ascertain some of the facts involved here, and I found him on the beach again. The only difference is that now he owns the beach. In 1968, Tom Knapp and Ed Anderson, also a Graham disciple, along with one or two other fellows of similar persuasion, formed Tweedy Brown Partners, and their investment results appear in Table 2. Tweedy Brown built that record with very wide diversification. They occasionally bought control of businesses, but the record of the passive investments is equal to the record of the control investments. Table 3 describes the third member of the group who formed Buffett Partnership in 1957. The best thing he did was to quit in 1969. Since then, in a sense, Berkshire Hathaway has been a continuation of the partnership in some respects. There is no single index I can give you that I would feel would be a fair test of investment management at Berkshire. But I think that any way you figure it, it has been satisfactory. Table 4 shows the record of the Sequoia Fund, which is managed by a man whom I met in 1951 in Ben Graham's class, Bill Ruane. After getting out of Harvard Business School, he went to Wall Street. Then he realized that he needed to get a real business education, so he came up to take Ben's course at Columbia, where we met in early 1951. Bill's record from 1951 to 1970, working with relatively small sums, was far better than average. When I wound up Buffett Partnership, I asked Bill if he would set up a fund to handle all our partners, so he set up the Sequoia Fund. He set it up at a terrible time, just when I was quitting. He went right into the two-tier market and all the difficulties that made for comparative performance for value-oriented investors. I'm happy to say that my partners, to an amazing degree, not only stayed with him, but added money, with a happy result shown. There's no hindsight involved here. Bill was the only person I recommended to my partners, and I said at the time that if he achieved a 4-point per annum advantage over the Standard & Poor's, that would be solid performance. Bill has achieved well over that, working with progressively larger sums of money. That makes things much more difficult. Size is the anchor of performance. There is no question about it. It doesn't mean you can't do better than average when you get larger, but the margin shrinks. And if you ever get so you're managing $2 trillion, and that happens to be the amount of the total equity evaluation in the economy, don't think that you'll do better than average. I should add that in the records we've looked at so far, throughout this whole period, there was practically no duplication in these portfolios. These are men who select securities based on discrepancies between price and value, but they make their selections very differently. Walter's largest holdings have been such stalwarts as Hudson Pulp and Paper, Jeddo Highland Coal in New York, Trap Rock Company, and all those other names that come instantly to mind to even a casual reader of the business pages. Tweedy Brown's selections have sunk even well below that level in terms of name recognition. On the other hand, Bill has worked with big companies. The overlap among these portfolios has been very, very low. These records do not reflect one guy calling the flip in 50. People yelling out the same thing after him. Table 5 is the record of a friend of mine who is a Harvard Law graduate who set up a major law firm. I ran into him in about 1960 and told him that law was fine as a hobby, but he could do better. He set up a partnership quite the opposite of Walter's. His portfolio was concentrated in very few securities, and therefore his record was much more volatile, but it was based on the same discount from value approach. He was willing to accept greater peaks and valleys of performance, and he happens to be a fellow whose whole psyche goes toward concentration, with the results shown. Incidentally, this record belongs to Charlie Munger, my partner for a long time in the operation of Berkshire Hathaway. When he ran his partnership, however, his portfolio holdings were almost completely different from mine and the other fellows mentioned earlier. Table 6 is the record of a fellow who was a pal of Charlie Munger's, another non-business school type, who was a math major at USC. He went to work for IBM after graduation and was an IBM salesman for a while. After I got to Charlie got to him. This happens to be the record of Rick Guerin. Rick, from 1965 to 1983, against a compounded gain of 316% for S&P, came off with 22,200%, which, probably because he lacks a business school education, he regards as statistically significant. One sidelight here, it is extraordinary to me that the idea of buying dollar bills for 40 cents takes immediately with people or doesn't take at all. It's like an inoculation. If it doesn't grab a person right away, I find that you can talk to him for years and show him records, and it doesn't make any difference. They just don't seem able to grasp the concept, simple as it is. A fellow like Rick Guerin, who had no formal education in business, understands immediately the value approach to investing, and he's applying it 5 minutes later. I've never seen anyone who became a gradual convert over a 10-year period to this approach. It doesn't seem to be a matter of ICOR academic training. It's instant recognition, or it is nothing. Table 7 is the record of Stan Perlmutter. Stan was a liberal, arts major at the University of Michigan, who was a partner in the advertising agency of Bozell and Jacobs. We happened to be in the same building in Omaha. In 1965, he figured out I had a better busy nest than he did, so he left advertising. Again, it took 5 minutes for Stan to embrace the value approach. Perlmutter does not own what Walter Schloss owns. He does not own what Bill Ruane owns. These are records made independently. But every time Perlmutter buys a stock, it's because he's getting more for his money than he's paying. That's the only thing he's thinking about. He's not looking at quarterly earnings projections. He's not looking at next year's earnings. He's not thinking about what day of the week it is. He doesn't care what investment research from any place says. He's not interested in price moment, TUM, volume, or anything. He's simply asking, what is the boozy nest worth? Table 8 and Table 9 are the records of 2 pension funds I've been involved in. They are not selected from dozens of pension funds with which I've had involvement. They are the only 2 I have. Influ, Enst. In both cases, I have steered them toward value-oriented managers. Very, very few pension funds are managed from a value standpoint. Table 8 is the Washington Post Company's pension fund. I was with a large bank some years ago, and I suggested that they would do well to select managers who had a value orientation. As you can see, overall, they have been in the top percentile ever since they made the change. The Post told the managers to keep at least 25% of these funds in bonds, which would not have been necessarily the choice of these managers. So I've included the bond performance simply to illustrate that this group has no particular expertise about bonds. They wouldn't have said they did, even with this drag of 25% of their fund in an area that was not their game. They were in the top percentile of fund management. The Washington Post experience does not cover a terribly long period, but it does represent many investment decisions by 3 managers who are not identified retroactively. Table 9 is the record of the FMC Corporation Fund. I don't manage a dime of it myself, but I did, in 1974, influence their decision to select value-oriented managers. Prior to that time, they had selected managers much the same way as most larger companies. They now, 540, rank number 1 in the Becker survey of pension funds for their size over the period of time subsequent to this conversion. TOTH, value approach. Last year, they had 8 equity managers of any duration beyond a year. 7 of them had a cumulative record better than the S&P. All 8 had a better record last year than the S&P. The net difference now between a median performance and the actual performance of the FMC fund over this period is $243 million. FMC attributes this to the mindset given to them about the selection of managers. Those managers are not the managers I would necessarily select, but they have the common denominator of selecting securities based on value. So these are 9 records of coin flippers from Graham and Doddsville. I haven't selected them with hindsight from among thousands. It's not like I am reciting to you the names of a bunch of lottery winners, people I had never heard of before they won the lottery. I selected these men years ago based upon their framework for investment decision-making. I knew what they had been taught, and additionally, I had some personal knowledge of their intellect, character, and temperament. It's very important to understand that this group has assumed far less risk than average. Note their record in years when the general market was weak. While they differ greatly in style, these investors are, mentally, always buying the business, not buying the stock. A few of them sometimes buy whole businesses. Far more often, they simply buy small pieces of businesses. Their attitude, whether buying all or a tiny piece of a business, is the same. Some of them hold portfolios with dozens of stocks. Others concentrate on a handful. But all exploit the difference between the market price of a business and its intrinsic value. I'm convinced that there is much inefficiency in the market. These Graham and Doddsville investors have successfully exploited gaps between price and value. When the price of a stock can be influenced by a herd on Wall Street with prices set at the margin by the most emotional person, or the greediest person, or the most depressed person, it is hard to argue that the market always prices rationally. In fact, market prices are frequently nonsensical. I would like to say one important thing about risk and reward. Sometimes risk and reward are correlated in a positive fashion. If someone were to say to me, I have here a 6-shooter, and I have slipped 1 cartridge into it, why don't you just spin it and pull it once? If you survive, I will give you $1 million. I would decline perhaps stating that $1 million is not enough. Then he might offer me $5 million to pull the trigger twice. Now that would be a posy. Tie of correlation between risk and reward. The exact opposite is true with value investing. If you buy a dollar bill for 60 cents, it's riskier than if you buy a dollar bill for 40 cents, but the expectation of reward is greater in the latter case. The greater the potential for reward in the value portfolio, the less risk there is. One quick example, the Washington Post Company in 1973 was selling for $80 million in the market. At the time that day, you could have sold the assets to any one of 10 buyers for not less than $400 million, probably appreciably more. The company owned the Post, Newsweek, plus several television stations in major markets. Those same properties are worth $2 billion now. So the person who would have paid $400 million would not have been crazy. Now, if the stock had declined even further to a price that made the valuation $40 million instead of $80 million, its beta would have been greater. And to people who think beta measures risk, the cheaper price would have made it look riskier. This is truly Alice in Wonderland. I have never been able to figure out why it's riskier to buy $400 million worth of properties for $40 million than $80 million. And as a matter of fact, if you buy a group of such securities and you know anything at all about business valuation, there is essentially no risk in buying $400 million for $80 million, particularly if you do it by buying $10, $40 million piles for $8 million each. Since you don't have your hands on the $400 million, you want to be sure you are in with honest and reasonably competent people, but that's not a difficult job. You also have to have the knowledge to enable you to make a very general estimate about the value of the underlying businesses, but you do not cut it close. That is what Ben Graham meant by having a margin of safety. You don't try and buy businesses worth $83 million for $80 million. You leave yourself an enormous margin. When you build a bridge, you insist it can carry 30,000 pounds, but you only drive 10,000-pound trucks across it. And that principle works in investing. Same in conclusion, some of the more commercially minded among. You may wonder why I'm writing this article. Adding many converts to the value approach will perforce narrow the spreads between price and value. I can only tell you that the secret has been out for 50 years, ever since Ben Graham and Dave Dodd wrote Security Analysis. Yet I have seen no trend toward value investing in the 35 years that I've practiced it. There seems to be some perverse human characteristic that likes to make easy things difficult. The academic world, if anything, has actually backed away from the teaching of value investing over the last 30 years. It's likely to continue that way. Ships will sail around the world, but the flat Earth society will flourish. There will continue to be wide discrepancies between price and value in the marketplace, and those who read their Graham and Dodd will continue to prosper. Tables 1 and -9 follow. 2. Important rules concerning taxability of investment, income and security, transactions in 1972. Editor's note: due to extensive changes in the rules governing such transactions, the following document is presented here for historical purposes only. When first written by Benjamin Graham in 1972, all the information therein was correct. However, intervening developments have rendered this document inaccurate for today's purposes. Following Graham's original Appendix 2 is a revised and updated version of the Basics of Investment Taxation, which brings the reader up to date on the relevant rules. Rule 1. Interest and dividends. Interest and dividends are taxable as ordinary income except A. Income received from state, municipal, and similar obligations, which are free from federal tax but may be subject to state tax. B. Dividends representing a return of capital. See certain dividends paid by investment companies, see below. And D. The first $100 of ordinary domestic corporation dividends. Rule 2. Capital gains and losses. Short-term capital gains and losses are merged to obtain net short-term capital gain or loss. Long-term capital gains and losses are merged to obtain the net long-term capital gain or loss. If the net short-term capital gain exceeds the net long-term capital loss, 100% of such excess shall be included in income. The maximum tax thereon is 25% up to $50,000 of such gains and 35% on the balance. In net capital loss, the amount exceeding capital gains is deductible from ordinary income to a maximum of $1,000 in the current year and in each of the next 5 years. Alternatively, unused losses may be applied at any time to offset capital gains. Carryovers of losses taken before 1970 are treated more liberally than later losses. Note concerning regulated investment companies: most investment funds, investment companies, take advantage of special provisions of the tax law which enable them to be year, VOIC, tax substantially as partnerships, thus, if they make long-term security profits, they can distribute these as capital gain dividends, which are reported by their shareholders in the same way as long-term gains. These carry a lower tax rate than ordinary dividends. Alternatively, such a company may elect to pay the 25% tax for the account of its shareholders and then retain the balance of the capital gains without distributing them as capital gain dividends. 3. The Basics of Investment Taxation, updated as of 2003. Interest and dividends. Interest and dividends are taxed at your ordinary income tax rate except A. Interest received from municipal bonds, which is free from federal income tax but may be subject to state tax. B. Dividends representing a return of capital, and C. Long-term capital gain distributions paid by mutual funds, see below. Private activity municipal. Bonds, even within a mutual fund, may subject you to the federal altar. Native minimum tax. Capital gains and losses. Your short-term capital gains and losses are merged to obtain net short-term capital gain or loss. Long-term capital gains and losses are merged to determine your net long-term capital gain or loss. If net short-term capital gain exceeds the net long-term capital loss, that excess is counted as ordinary income. If there is a net long-term capital gain, it is taxed at the favorable capital gains rate, generally 20, which will fall to 18% for investments purchased after December 31st, 2000s, and held for more than 5 years. A net capital loss is deductible from ordinary income to a maximum of $3,000 in the current year. Any capital losses in excess of $3,000 million may be applied in later tax years to offset future capital gains, ODA, Tandy Hole, corporate income tax. After selling long-term holdings, mutual funds can distribute the profits as capital gain dividends, which their shareholders treat as long-term gains. These are taxed at a lower rate, generally 20%, than ordinary dividends, up to 39%. You should generally avoid making large new investments during the fourth quarter of each, when these capital gain distributions are usually distributed. Year-wise, you will incur tax for a gain earned by the fund before you even owned it. 4. The new speculation in common stock zone. What I shall have to say will reflect the spending of many years in Wall Street, with their attendant varieties of experience. This has included the recurrent advent of new conditions or a new atmosphere which challenge the value of experience itself. It is true that one of the elements that distinguish economics, finance, and security analysis from other practical disciplines is the uncertain valid. Idea of past phenomena as a guide to the present and future, yet we have no right to reject the lessons of the past until we have at least studied and understood them. My address today is an effort towards such understanding in a limited field in particular, an endeavor to point out some contrasting relationships between the present and the past and our underlying attitudes toward investment and speculation in common stocks. The SPICU. Let me start with a summary of my thesis. In the past, latent elements of a common stock resided almost exclusively in the company itself. They were due to uncertainties, or fluctuating elements, or downright weaknesses in the industry, or the corporation's individual setup. These elements of speculation still exist, of course, but it may be said that they have been sensibly diminished by a number of long-term developments to which I shall refer. But in revenge, a new and major element of speculation has been introduced into the common stock arena from outside the companies. It comes from the attitude and viewpoint of the stock-buying public and their advisors, chiefly U.S. security analysts. This attitude may be described in a phrase, primary emphasis upon future expecta. Shans. Nothing will appear more logical and natural to this audience than the idea that a common stock should be valued and priced, primarily on the basis of the company's expected future performance. Yet this simple appearing concept carries with it a number of paradoxes and pitfalls. For one thing, it obliterates a good part of the older, well-established distinctions between investment and speculation. The dictionary says that speculate comes from the Latin specula, a lookout. Thus it was the speculator who looked out and saw future developments coming before other people did. But today, if the investor is shrewd or well-advised, he too must have his lookout on the future, or rather he mounts into a common lookout where he rubs elbows with the speculator. Secondly, we find that, for the most part, companies with the best investment characteristics, i.e. the best credit rating, are the ones which are likely to attract the largest speculative interest in their common stocks, since everyone assumes they are guaranteed a brilliant future. Thirdly, the concept of future prospects, and particularly of continued growth in the future, invites the application of formulas out of higher mathematics to establish the present value of the favored issues. But the combination of precise formulas with highly imprecise assumptions can be used to establish, or rather to justify, practically any value one wishes, however high, for a really outstanding issue. But, paradoxically, that very fact on close examination will be seen to imply that no one value, or reasonably narrow range of values, can be counted on to establish and maintain itself for a given growth company. Hence, at times, the market may conceivably value the growth component at a strict, ingly low figure. Returning to my distinction between the older and newer spec. Relative elements in common stock, we might characterize them by two outlandish but convenient words, viz. Endogenous and exogenous. Let me illustrate briefly the old-time speculative common stock as distinguished from an investment stock by some data relating to American Can and Pennsylvania Railroad in 1911 to 1913. These appear in Benjamin Graham and David L. Dodd Security Analysis, McGraw-Hill, 1940 pp. In those 3 years, the price range of Pensy moved only between 53 and 65, or between 12.2 and 15 times its average earnings for the period. It showed steady profits, was paying a reliable $3 dividend, and investors were sure that it was backed by, well, over its spar of $50 intangible assets. By contrast, the price of Famer ICANN can range between 9 and 47, its earnings between 7 cents and $8.86. The ratio of price to the 3-year average earnings moved between 1.9 times and 10 times. It paid no dividend at all. And sophisticated investors were well aware that the $100 par value of the common represented nothing but undisclosed water, since the preferred issue exceeded the tangible assets available for it. Thus, American Can Common was a representative speculative issue, because American Can Company was then a speculatively capitalized enterprise in a fluctuating and uncertain industry. Actually, American Can had a far more brilliant long-term future than Pennsylvania Railroad, but not only was this fact not suspected by investors or speculators in those days, But even if it had been, it would probably have been put aside by the investors as basically irrelevant to investment policies and programs in the years 1911 to 1913. Now, to expose you to the development through time of the importance of long-term prospects for investments, I should like to use as my example our most spectacular giant industrial enterprise, none other than International Business Machines, which last year entered the small group of companies with $1 billion of sales. May I introduce one or two autobiographical notes here, in order to inject a little of the personal touch into what otherwise would be an excursion into cold figures? In 1912, I had left college for a term to take charge of a research project for us. Express Company. We set out to find the effect on revenues of a proposed revolutionary new system of computing express rates. For this purpose, we used the so-called hollerith machines leased out by the then computing tabulating recording company. They comprised card punches, card sorters, and tabulators, tools almost unknown to businessmen then, and having their chief application in the Census Bureau. I entered Wall Street in 1914, and the next year the bonds and common stock of CTR company were listed on the New York Stock Exchange, while I had a kind of sentimental interest in that enterprise. And besides, I considered myself a sort of technological expert on their products, being one of the few financial people who had seen and used them. So early in 1916, I went to the head of my firm, known as Mr. A.N., and pointed out to him that CTR stock was selling the middle 40s for 105,000 shares, that it had earned $6.50 in 1915, that its book value, including, to be sure, some non-segregated intangibles, was $130, that it had started a $3 dividend, and that I thought rather highly of the company's products and prospects. Mr. A.N. looked at me pityingly. "Ben," said he, "do not mention that company to me again. I would not touch it with a 10-foot pole." His favorite expression. Its 6% bonds are selling in the low. 80s and they are no good, so how can the stock be any good? Everybody knows there is nothing behind it but water. Glossary. In those days, that was the ultimate of condemnation. It meant that the asset account of the balance sheet was fictitious. Many industrial companies, notably us, Steel, despite their $100 par, represented nothing but water concealed in a written-up plan account. Since they had nothing to back them but earning power and future prospects, no self-respecting investor would give them a second thought. I returned to my statistician's cubbyhole, a chastened young man. Mr. N was not only experienced and successful, but extremely shrewd as well. So much was I impressed by his sweeping condemnation of computing, tabulating, recording, that I never bought a share of it in my life, not even after its name was changed to International Business Machines in 1926. Now let us take a look at the same company with its new name in 1926, a year of pretty high stock markets. At that time, it first revealed the goodwill item in its balance sheet in the rather large sum of $13.6 million. AN had been right. Practically every dollar of the so-called equity behind the common in 1915 had been nothing but water. However, since that time, the company had made an impressive record under the direction of T.L. Watson Sr. Its net had risen from $691,000 to $3.7 million, over five-fold a greater percentage gain than it was to make in any subsequent 11-year period. It had built up a nice tangible equity for the common and had split it 3.6 for 1. It had established a $3 dividend rate for the new stock, while earnings were $6.39 thereon. You might have expected the 1926 stock market to have been pretty enthusiastic about a company with such a growth history and so strong a trade position. Let us see. The price range for that year was 31 low, 59 high. At the average of 45, it was selling at the same 7 times multiplier of earnings and the same 6.7% dividend yield as it had done in 1915. At its low of 31, it was not far in excess of its tangible book value, and in that respect was far more than 11 years earlier, conservatively priced. These data illustrate, as well as any can, the persistence of the old-time investment viewpoint until the culminating years of the bull market of the 1920s. What has happened since then can be summarized by using 10-year intervals in the history of IBM. In 1936, net expanded to twice the 1926 figures, and the average multiplier rose from 7 to 17%. From 1936 to 1946, the gain was 21 times, but the average multiplier in 1946 remained at 17%. Then the pace, accelerated. The 1956 net was nearly 4 times that of 1946. And the average multiplier rose to 321 too. Last year, with a further gain in net, the multiplier rose again to an average of 42, if we do not count the unconsolidated equity in the foreign subsidiary. When we examine these recent price figures with care, we see some interesting analogies and contrasts with those of 40 years earlier. The one-time scandalous water, so prevalent in the balance sheets of industrial companies, has all been squeezed out first by disclosure and then by write-offs. But a different kind of water has been put back into the valuation by the stock market, by investors and speculators themselves. When IBM now sells at 7 times its book value instead of 7 times earnings, the effect is practically the same as if it had no book value at all. Or the small book value portion can be considered as a sort of minor preferred stock component of the price. The rest representing exactly the same sort of commitment as the old-time speculator made when he bought Woolworth or us. Steal common entirely for their earning power and future prospects. It is worth remarking in passing that in the 30 years which saw IBM transform from a 7 times earnings to a 40 times earnings enterprise, many of what I have called the endogenous speculative aspects of our large industrial companies have tended to disappear, or at least to diminish greatly. Their financial positions firm, their capital structures conservative, they are managed far expertly and even more honestly than before. Furthermore, the requirements of complete disclosure have removed one of the important speculative elements of years ago that derived from ignorance and mystery. More. Another personal digression here. In my early years in the street, one of the favorite mystery stocks was Consolidated Gas of New York, now Consolidated Edison. It owned as a subsidiary the Prof. Idaho, New York Edison Company, but it reported only dividends received from the source, not its full earnings, the unreported EDI. Sun earnings supplied the mystery and the hidden value. To my surprise, I discovered that these hush-hush figures were actually on file each year with the Public Service Commission of the state. It was a simple matter to consult the records and to present the true earnings of Consolidated Gas in a magazine article. Incidentally, the addition to profits was not spectacular. One of my older friends said to me then, "Ben, you may think you are a great guy to supply those missing figures, but Wall Street is going to thank for nothing. Consolidated Gas with the mystery is both more interesting and more valuable than X-mystery. You youngsters who want to stick your noses into everything are going to ruin Wall Street." It is true that the 3 M's which then supplied so much fuel to the speculative fires have now all but disappeared. These were mystery, manipulation, and thin margins. But we security analysts have ourselves been creating valuation approaches which are so speculative in themselves as to pretty well take the place of those older speculative factors. Do we not have our own 3Ms? Now, none other than Minnesota Mining and Manufacturing Company, and does not this common stock illustrate perfectly the new speculation as contrasted with the old? Consider a few figures. When M&M Common sold at 101 last year, the market was valuing it at 44 times 1956 earnings, which happened to show no increase to speak of in 1957. The enterprise itself was valued at $1.7 billion, of which $200 million was covered by net assets, and a cool $1 billion represented the market's appraisal of goodwill. We do not know the process of calculation by which that valuation of goodwill was arrived at. We do know that a few months later, the market revised this appraisal downward by some $450 million, or about 30%. Obviously, it is impossible to calculate accurately the intangible component of a splendid company such as this. It follows as a kind of mathematical law that the more important the goodwill or future earning power factor, the more uncertain becomes the true value of the enterprise, and therefore the more speculative inherently the common stock. It may be well to recognize a vital difference that has developed in the valuation of these intangible factors. When we compare Lear times with today. A generation or more ago, it was the standard rule, recognized both in average stock prices and in formal or legal valuations, that intangibles were to be appraised on a more conservative basis than tangibles. A good industrial company might be required to earn between 6% and 8% on its tangible assets, represented typically by bonds and preferred stock, but its excess earnings, or the intangible assets they gave rise to, would be valued on, say, a 15% basis. You will find approximately these ratios in the initial offering of Woolworth preferred and common stock in 1911, and in numerous others. But what has happened since the 1920s? Essentially, the exact reverse of these relationships may now be seen. A company must now typically earn about 10% on its common equity to have it sell in the average market at full book value. But its excess earnings, above 10% on capital, are usually valued more liberally or at a higher multiplier than the base earnings required to support the book value in the market. Thus, a company earning 15% on the equity may well sell at 130.12 times earnings or twice its net assets. This would mean that the first 10% earned on capital is valued at only 10 times, but the next 5%, what used to be called the excess, is actually valued at 20 times. Now, there is a logical reason for this reversal in valuation procedure, which is related to the newer emphasis on growth expectations. Companies that earn a high return on capital are given these liberal appraisals not only because of the good profitability itself and the relative stability associated with it, but perhaps even more. Cogently, because high earnings on capital generally go hand in hand with a good growth record and prospects. Thus, what is really paid for nowadays in the case of highly profitable companies is not the goodwill in the old and restricted sense of an established name in a profitable business, but rather their assumed superior expectations of increased profits in the future. This brings me to one or two additional mathematical aspects of the new attitude toward common stock valuations, which I shall touch on merely in the form of brief suggestions. If, as many tests show, the earnings multiplier tends to increase with profitability, E, as the rate of return on book value increases, then the arith of this feature is that value tends to increase. Medical consequence directly as the square of the earnings, but inversely the book value. Thus, in an important and very real sense, tangible assets have become a drag on average market value rather than a source thereof. Take a far from extreme illustration. If Company A earns $4 a share on a $20 book value, and Company B also $4 a share on a $100 book value, Company A is almost certain to sell at a higher multiplier, and hence at higher price than Company B, say $60 for Company A shares and $35 for Company B shares. Thus, it would not be inexact to declare that the $80 per share of greater assets for Company B are responsible for the $25 per share lower market price, since the earnings per share are assumed to be equal. But more important than the foregoing is the general relationship between mathematics and the new approach to stock values. Given the three ingredients of A, optimistic assumptions as to the rate of earnings growth, B, a sufficiently long projection of this growth into the future, and C, the miraculous workings of compound interest, low, the security analyst is supplied with a new kind of philosopher's stone which can produce or justify any desired valuation for a really good stock. I've commented in a recent article in the Analyst Journal on the vogue of higher mathematics in bull markets, and quoted David Duran's exposition of the striking analogy between value calculations of growth stocks and the famous Petersburg paradox, which has challenged and confused mathematicians for more than 200 years. The point I want to make here is that there is a special paradox in the relationship between mathematics and investment attitudes on common stocks, which is this: mathematics is ordinarily considered as producing precise and dependable results. But in the stock market, the more elaborate and abstruse the mathematics, the more uncertain and speculative are the conclusions we draw therefrom. In 44 years of Wall Street experience and study, I have never seen dependable calculations made about common stock values or related investment policies that went beyond simple arithmetic or the most elementary algebra. Whenever calculus is brought in, or higher algebra, you could take it as a warning signal that the operator was trying to substitute theory for experience and use you. Alley also to give to speculation the deceptive guise of investment. The older ideas of common stock investment may seem quite naive to the sophisticated security analyst of today. The great emphasis was always on what we now call the defensive aspects. Company or issue mainly the assurance that it would continue its dividend unreduced in bad times. Thus, the strong rail, the roads, which constituted the standard investment commons of 50 years ago, were actually regarded in very much the same way as the public utility commons in recent years. If the past record indicated stability, the chief requirement was met. Not too much effort was made to anticipate adverse changes of an underlying character in the future. But conversely, especially favorable future prospects were regarded by shrewd investors as something to look for but not to pay for. In effect, this meant that the investor did not have to pay anything substantial for superior long-term prospects. He got these virtually without extra cost, as a reward for his own superior intelligence and judgment in picking the best rather than the merely good companies. For common stocks with the same financial strength, past earnings record, and dividend stability, all sold about the same dividend yield. This was indeed a short-sighted point of view, but it had the great advantage of making common stock investment in the old days not only simple, but also basically sound and highly profitable. Let me return for the last time to a personal note. Somewhere around 1920, our firm distributed a series of little pamphlets entitled Lessons for Investors. Of course, it took a brash analyst in his middle 20s like myself to hit on so smug and presumptuous a title. But in one of the papers, I made the casual statement that if a common stock is a good investment, it is also a good speculation. For reasoned I, if a common stock was so sound that it carried very little risk of loss, it must ordinarily be so good as to possess excellent chances for future gains. Now, this was a perfectly true and even valuable discovery, but it was true only because nobody paid any attention to it. Some years later, when the public woke up to the historical merits of common stocks as long-term investments, they soon ceased to have any such merit, because the public's enthusiasm created price levels which deprived them of their built-in margin of safety, and thus drove them out of the investment class. Then, of course, the pendulum swung to the other extreme, when in 931. That no common stock could ever be an investment, and we soon saw one of the most respected authorities declaring, "Find another set of paradoxes in the investor's changing attitude when we view this long-range experience in perspective toward capital gains as contrasted with income." It seems a truism to say that the old-time common stock investor was not much interested in capital gains. He bought almost entirely for safety and income and let the speculator concern himself with price appreciation. Today, we are likely to say that the more experienced and shrewd the investor, the less attention he pays to dividend returns, and the more heavily his interest centers on long-term appreciation. Yet, one might argue perversely that precisely because the old-time investor did not concentrate on future capital appreciation, he was virtually guaranteeing to himself that he would have it, at least in the field of industrial stocks. And conversely, today's investor is so concerned with anticipating the future that he is already paying handsomely for it in advance. Thus, what he has, projected with so much study and care, may actually happen and still not bring him any profit. If it should fail to materialize to the degree expected, he may in fact be faced with a serious temporary and perhaps even permanent loss. What lessons, again, using the pretentious title of my 1920 pamphlet, can the analyst of 1958 learn from this linking of past with current attitudes? Not much of value, one is inclined to say. We can look back nostalgically to the good old days when we paid only for the present and could get the future for nothing, and all this and heaven too combination. Shaking our heads sadly, we mutter, those days are gone forever. Have not investors and security analysts eaten of the tree of knowledge of good and evil prospects? By so doing, have they not permanently expelled themselves from that Eden where promising common stocks at reasonable prices could be plucked off the bushes? Are we doomed always to run the risk either of paying unreasonably high prices for good quality and prospects, or of getting poor quality and prospects when we pay what seems a reasonable price? It certainly looks that way, yet one cannot be sure even of that pessimistic dilemma. Recently, I did a little research in the long-term history of that towering enterprise, General Electric Stimu, laded by the arresting chart of 59 years of earnings and dividends appearing in the recently published 1957 report. These figures are not without their surprises for the knowledgeable list. For one thing, they show that prior to 1947, the growth of GE was fairly modest and quite irregular. The 1946 earnings per share adjusted were only 30% higher than in 1902 to 52 cents for ANA. So is 40 cents, and in no year of this period were the 1902 earnings as much as doubled. Yet the price-earnings ratio rose from 9 times in 1910 and 1916 to 29 times in 1936 and again in 1946. One might say, of course, that the 1946 multiplier at least showed the well-known prescience of shrewd investors. We analysts were able to foresee then the really brilliant period of growth that was looming ahead in the next decade. Maybe so. But some of you remember that the next year, 1947, which established an impressive new high for GE's per-share earnings, was marked also by an extraordinary fall in the price-earnings ratio. At its low of 32 before the 3-1 split, GE actually sold again at only 9 times its current earnings, and its average price for the year was only about 10 times earnings. Our crystal ball certainly clouded over in the short space off 12 months. This striking reversal took place only 11 years ago. It casts some little doubt in my mind as to the complete dependability of the popular belief among analysts that prominent and promising companies will now always sell at high price earnings ratios, that this is a fundamental fact of life for investors, and they may as well accept and like it. I have no desire at all to be dogmatic on this point. All I can say is that it is not settled in my mind, and each of you must seek to settle it for yourself. But in my concluding remarks, I can say something definite about the structure of the market for various types of common stocks, in terms of their investment and speculative characteristics. In the old days, the investment character of a common stock was more or less the same as, or proportionate with, that of the enterprise itself, as measured quite well by its credit rating. The lower the yield on its bonds or preferred, the more likely was the common to meet all the criteria for satisfactory investment, and the smaller the element of speculation involved in its purchase. This relationship between the speculative ranking of the common and the investment rating of the company could be graphically expressed pretty much as a straight line descending from left to right, but nowadays I would describe the graph as U-shaped, at the left, where the company itself is speculative, and its credit low. The common stock is, of course, highly speculative, just as it has always been in the past. At the right extremity, however, where the company has the highest credit rating, because both its past record and future prospects are most impressive, we find that the stock market tends more or less continuously to introduce a highly speculative element into the common shares, through the simple of a price so high as to carry a fair degree of risk. Means at this point, I cannot forbear introducing a surprisingly relevant, if quite exaggerated, quotation on the subject which I found recently in one of Shakespeare's sonnets. It reads, "Have I not seen dwellers on form and favor lose all and more by paying too much rent?" Returning to my imaginary graph, it would be the center area where the speculative element in common stock purchases would tend to reach its minimum. In this area, we could find many well-established and strong companies, with a record of past growth corresponding to that of the national economy, and with future prospects apparently of the same character. Such common stocks could be bought at most times, except in the upper ranges of a bull market, at moderate prices in relation to their indicated intrinsic values. As a matter of fact, because of the present tendency of investors and speculators alike to concentrate on more glamorous issues, I should hazard the statement that these middle ground stocks tend to sell on the whole rather below their independently determinable values. They thus have a margin of safety factor supplied by the same market preferences and prejudices which tend to destroy the margin of safety in the more promising issues. Furthermore, in this wide array of companies, there is plenty of room for penetrating analysis of the past record and for discriminating choice in the area of future prospects, to which can be added the higher assurance of safety conferred by diversification. When Phaethon insisted on driving the chariot of the sun, his father, the experienced operator, gave the neophyte some advice which the latter failed to follow to his cost. Ovid summed up Phoebus Apollo's counsel in 3 words. Medius tutissimus ibis, you will go safest in the middle. Corsathincus principle holds good for investors and their security analyst advisors. Juju in DEA 5. A case history. At the Maintenance Company, the first part of this history is reproduced from our 1965 edition, where it appeared under the title, A Horrible Example. The second part summarizes the later metamorphosis of the enterprise. We think it might have a salutary effect on our readers' future attitude toward new common stock offerings if we cited one horrible example here in some detail. It is taken from the first page of Standard & Poor's Stock Guide, and illustrates in extreme fashion the glaring weaknesses of the 1,961,962 flotations, the extraordinary overvaluations given them in the market, and the subsequent collapse. In November 1961, 154,000 shares of Aetna Maintenance Company common were sold to public at $9, and the price promptly advanced to $15. Before the financing, the net assets per share were about $1.20, but they were increased to slightly over $3 per share by the money received for the new shares. The sales and earnings prior to the financing were 576 appendixes, the nature of this highly competitive business to ensure future stability, At the high price soon after issuance, the heedless public was paying much more per dollar of earnings and assets than for most of our large and strong companies. This example is admittedly extreme, but is far from unique. The instances of lesser, but inexcusable, overvaluations run into the hundreds. Sequel 1965 to 1970. In 1965, new interests came into the company. The unprofitable building maintenance business was sold out, and the company embarked in an entirely different venture, making electronic devices. The name was changed to Hayden Switch and Instrument Company. The earnings results have not been impressive. In the 5 years 1965 to 1969, the enterprise showed average earnings of only 8 cents per share of old stock, with 34 cents earned in the best year, 1967. However, in true modern style, the company split the stock 2-for-1 in 1968. The market price also ran true to Wall Street form. It advanced from in 1964 to the equivalent of 16% in 1968 after the split. The price now exceeded the record set in the enthusiastic days of 1961. This time the overvaluation was much worse than before. The stock was now selling at 52 times the earnings of its only good year and some 200 times its average earnings. Also, the company was again to a reported deficit in the very year that the new high price was established. The next year, 1969, the bid price fell to $1. Questions. Did the idiots who paid $8 for the stock in 1968 know anything at all about the company's previous history, its 5-year earnings record, its asset value very small? Did they have any idea of how much, or rather how little, they were getting for their money? Did they care? Has anyone on Wall Street any responsibility at all for the regular recurrence of completely brainless, shockingly widespread, and inevitable catastrophic specula in this kind of vehicle? 6. Tax accounting for NVF's acquisition of Sharon. Steel shares. 1. NVF acquired 88% of Sharon stock in 1969, paying for each. Share $70 in NVF 5 bonds, due 1994, and warrants to buy Elevent 2. Shares of NVF at $22 per share. The initial market value of the bonds appears to have been only 43% of par, while the warrants were quoted at $10 per NVF share involved. This meant that the shareholders got only $30 worth of bonds, but $15 worth of warrants for each share turned in, a total of $45 per share. This was about the average price of Sharon in 1968, and also its closing price for the year. The book value of Sharon was $60 per share. The difference between this book value and the market value of Sharon stock amounted to about $21 million on the 1D415, 0.000 shares of Sharon acquired. 2. The accounting treatment was designed to accomplish 3 things. A. To treat the issuance of the bonds as equivalent to a sale thereof at 43, giving the company an annual deduction from income for amortization of the huge bond discount of $54 million. Actually, it would be charging itself about 15% annual interest on the proceeds of the $99 million debenture issue. B. To offset this bond discount charge by an approximately equal profit, consisting of a credit to income of 1/10 of the difference between the cost price of 45 for the Sharon stock and its book value of 60. This would correspond in reverse fashion to the required practice of charging income each year with a part of the price paid for acquisitions in excess of the book value of the assets acquired. The beauty of this arrangement would be that the company could save initially about $900,000 a year, or $1 per share, in income taxes from these 2 annual entries, because the amortization of bond discount could be deducted from taxable income, but the amortization of excess of equity over cost did not have to be included in taxable income. 3. This accounting treatment is reflected in both the consolidated income account and the consolidated balance sheet of NVF for 1969 and pro forma for 1968. Since a good part of the cost of Sharon stock was to be treated as paid for by warrants, it was necessary to show the initial market value of the warrants as part of the common stock capital figure. Thus, in this case, as in no other that we know, the warrants were assigned a substantial value in the balance sheet, namely $22 million, but only in an explanatory. Note 7. Technological companies as investments. In the Standard & Poor's services in mid to 1971, there were listed about 200 companies with names beginning with Compu. Data, Electro, Cyan, Techno. About half of these belonged to some part of the computer industry. All of them were traded in the market or had made applications to sell stock to the public. A total of 46 such companies appeared in the S&P stock guide for September 1971. Of these, 26 were reporting deficits, only 6 were earning over $1 per share, and only 5% were paying dividends. In the December 1968 stock guide, there had appeared 45 companies with similar technological names. Tracing the sequel of this list, as shown in the September 1971 guide, we find the following developments. Comment: It is virtually certain that the many technological companies not included in the guide in 1968 had a poorer subsequent record than those that were included. Also that the 12 companies dropped from the list did worse than those that were retained. The harrowing results shown by these samples are no doubt reasonably indicative of the quality and price history of the entire group of technology issues. The phenomenal success of IBM and a few other companies was bound to produce a spate of public offerings of new issues in their fields, for which large losses were virtually guaranteed.